Change. Adapt. Transform. The pillars that define who we are now guide the ecosystems we are building. Ecosystems that will help shape the world of tomorrow, together, for everyone. SR Group is a global conglomerate operating across energy, infrastructure, metals and mining, and technology and retail. SR today generates revenues of approximately $15 billion, employs over 7,000 people globally. We are also committed to community growth and welfare in sports, health, education at the grassroots level. The DNA of SR is embedded in everything we do. It is the compass that has shaped our journey for nearly half a century and will continue to guide us through the century ahead. SR, transforming tomorrow.
The global economy is reshaping. Capital, innovation, and enterprise now follow growth, talent, and resilience. Businesses are rethinking where and how they expand. India is at the center of this global shift, the world's largest democracy, and on its way to becoming the third largest economy, a digital powerhouse, a trusted global partner where global businesses connect, grow, and innovate. And at the heart of this ambition is GIFT City, Gujarat International Finance Tech City, India's first operational international financial services center and smart city, strategically located in Gujarat, just 500 kilometers north of Mumbai. Spread across 886 acres, GIFT City integrates an international financial services center, IFSC, a special economic zone, and a domestic economic zone, all within a single master-planned, globally aligned business ecosystem. Connected by high-speed highways, dedicated rail links, and proximity to major airports and ports, GIFT City links seamlessly to key global markets across Asia, Europe, and the Americas. GIFT City is fast becoming a preferred destination for global business. Today, more than 1,000 enterprises are operational, spanning banking, capital markets, funds, insurance, wealth management, and global treasury functions. Aircraft and ship leasing platforms operate alongside fintech and digital finance firms, global capability centers, and technology-led enterprises, serving markets across regions. Within GIFT City, businesses can operate in foreign currency, raise international capital, and serve global clients directly from India. A growing fund ecosystem, expanding institutional presence, and a time zone advantage that bridges Asia, Europe, and the Americas are positioning GIFT City as a natural gateway for global capital and services into India's growth story. At GIFT City, businesses benefit from a single window regulatory framework, competitive fiscal incentives and tax efficiencies, faster approvals and simplified compliance, lower operating costs than peer global hubs, world-class infrastructure with resilient power, smart mobility, and digital governance, and a walk-to-work, high-quality lifestyle designed to attract top global talent. GIFT City is where finance meets technology, where global ambition meets Indian scale, and where the next generation of international business is taking shape. GIFT City, India's international financial gateway.
We've come a long way to get to where we are today. From what started as a single dream to enabling millions of dreams. From a handful of experts to thousands in our team. From two-wheeler to becoming a financing leader, we cover the length and breadth of our nation. As India moves forward, we move forward. With resilience, resolve, and determination. With a focus on digital and innovation. We are relentless in our drive as we strive to meet and exceed the evolving needs of being Bharat ka digital lender. In a market filled with increasing choice, we needed to find our unique brand voice. As part of our journey to tell our growth story, we spoke to people across the country, covering all our stakeholders from customers, channel partners, and employees. We sought inspiration in their values and aspirations. We breathe new life in our brand identity, framing human stories through windows of opportunity, reflecting our vision to empower upward mobility, broadening horizons through financial accessibility. Our loans symbolize a dose of confidence, the confidence to make it happen, the confidence to take action, to form collaborations, to go further than we have ever before, to become an inspiration and hero to all. Hero FinCorp, the confidence to make it happen.
Change. Adapt. Transform. The pillars that define who we are now guide the ecosystems we are building, ecosystems that will help shape the world of tomorrow, together, for everyone. SR Group is a global conglomerate operating across energy, infrastructure, metals and mining, and technology and retail. SR today generates revenues of approximately $15 billion, employs over 7,000 people globally. We are also committed to community growth and welfare in sports, health, education at the grassroots level. The DNA of SR is embedded in everything we do. It is the compass that has shaped our journey for nearly half a century and will continue to guide us through the century ahead. SR, transforming tomorrow.
The global economy is reshaping. Capital, innovation, and enterprise now follow growth, talent, and resilience. Businesses are rethinking where and how they expand. India is at the center of this global shift, the world's largest democracy, and on its way to becoming the third largest economy, a digital powerhouse, a trusted global partner where global businesses connect, grow, and innovate. And at the heart of this ambition is GIFT City, Gujarat International Finance Tech City, India's first operational international financial services center, and smart city, strategically located in Gujarat, just 500 kilometers north of Mumbai. Spread across 886 acres, GIFT City integrates an international financial services center, IFSC, a special economic zone, and a domestic economic zone, all within a single master-planned, globally aligned business ecosystem, connected by high-speed highways, dedicated rail links, and proximity to major airports and ports. GIFT City links seamlessly to key global markets across Asia, Europe, and the Americas. GIFT City is fast becoming a preferred destination for global business. Today, more than 1,000 enterprises are operational, spanning banking, capital markets, funds, insurance, wealth management, and global treasury functions. Aircraft and ship leasing platforms operate alongside fintech and digital finance firms, global capability centers, and technology-led enterprises, serving markets across regions. Within GIFT City, businesses can operate in foreign currency, raise international capital, and serve global clients directly from India. A growing fund ecosystem, expanding institutional presence, and a time zone advantage that bridges Asia, Europe, and the Americas are positioning GIFT City as a natural gateway for global capital and services into India's growth story. At GIFT City, businesses benefit from a single window regulatory framework, competitive fiscal incentives and tax efficiencies, faster approvals and simplified compliance, lower operating costs than peer global hubs, world-class infrastructure with resilient power, smart mobility, and digital governance, and a walk-to-work, high-quality lifestyle designed to attract top global talent. GIFT City is where finance meets technology, where global ambition meets Indian scale, and where the next generation of international business is taking shape. GIFT City, India's international financial gateway.
We've come a long way to get to where we are today. From what started as a single dream to enabling millions of dreams. From a handful of experts to thousands in our team. From two-wheeler to becoming a financing leader, we cover the length and breadth of our nation. As India moves forward, we move forward. With resilience, resolve, and determination. With a focus on digital and innovation. We are relentless in our drive as we strive to meet and exceed the evolving needs of being Bharat ka digital lender. In a market filled with increasing choice, we needed to find our unique brand voice. As part of our journey to tell our growth story, we spoke to people across the country, covering all our stakeholders from customers, channel partners, and employees. We sought inspiration in their values and aspirations. We breathe new life in our brand identity, framing human stories through windows of opportunity, reflecting our vision to empower upward mobility, broadening horizons through financial accessibility. Our loans symbolize a dose of confidence, the confidence to make it happen, the confidence to take action, to form collaborations, to go
What happens when two of the world's great democracies decide to move faster? From Mumbai's trading floors to London's corridors of influence, for 8 years, UK India Week has been the room where it happens. Capital, innovation, scale. West Midlands to the City of London, bringing together leaders in finance, AI, life sciences, and other frontier technologies.
UK India Week is back. This year's theme, Capital Corridors, exploring the future of UK-India innovation. 22nd to 26th June 2026. The room is already filling. Secure your place now.
The world is shifting, economies are rewiring, and one platform is connecting the people waiting to be a part of the India growth story. India Global Forum is where the world meets global India. An exclusive platform connecting leaders, investors, policymakers, and change-makers across continents, bringing together ideas, investment, and influence. Our stages spark change. Our premium and unmatched curated experiences unlock new possibilities. We connect the dots between tech and policy, innovation and investment, business and diplomacy. For our partners, IGF is more than a platform. It's a launchpad. It is access, visibility, gravitas. From India to UK, UAE to USA, we bring you to the heart of the conversations that power the next era of progress. We believe India's growth is the world's opportunity, and we are the gateway to seize it. This is where global ambition meets Indian momentum, where governments, investors, founders, and thinkers move from talk to trust to action. This is where ideas go global.
What if your next conversation didn't just inspire you, but opened a global opportunity? IGF Networks brings together global leaders, innovators, and decision makers, not to talk about the future, but to shape it. Rooted in India's global story and connected to the world's opportunity, it is a thoughtfully curated community where members gain access to powerful networks, strategic insight, and private platforms where real influence is built. It's built on values that matter: impact, integrity, innovation, and trust. Because this is more than a membership. It's belonging to a global community, shaping what comes next. Register your interest for IGF Networks.
The world is shifting, economies are rewiring, and one platform is connecting the people waiting to be a part of the India growth story. India Global Forum is where the world meets global India. An exclusive platform connecting leaders, investors, policymakers, and change-makers across continents, bringing together ideas, investment, and influence. Our stages spark change. Our premium and unmatched curated experiences unlock new possibilities. We connect the dots between tech and policy, innovation and investment, business and diplomacy. For our partners, IGF is more than a platform. It's a launchpad. It is access, visibility, gravitas. From India to UK, UAE to USA, we bring you to the heart of the conversations that power the next era of progress. We believe India's growth is the world's opportunity, and we are the gateway to seize it. This is where global ambition meets Indian momentum, where governments, investors, founders, and thinkers move from talk to trust to action. This is where ideas go global. The world is shifting, economies are rewiring, and one platform is connecting the people waiting to be a part of the India growth story. India Global Forum is where the world meets global India. An exclusive platform connecting leaders, investors, policymakers, and change makers across continents, bringing together ideas, investment, and influence. Our stages spark change. Our premium and unmatched curated experiences unlock new possibilities. We connect the dots between tech and policy, innovation and investment, business and diplomacy. For our partners, IGF is more than a platform. It's a launchpad. It is access, visibility, gravitas. From India to UK, UAE to USA, we bring you to the heart of the conversations that power the next era of progress. We believe India's growth is the world's opportunity, and we are the gateway to seize it. This is where global ambition meets Indian momentum, where governments, investors, founders, and thinkers move from talk to trust to action. This is where ideas go global.
Good afternoon. Sorry, is there anyone in the room? Good afternoon. Good. I'm Mark, by the way. You can call me Mark, or the MC, or the host, or the moderator, whatever you like to. Welcome. Lovely to see you. Day 2 of IGF Mumbai 2026, Catalysing Capital. I love the theme of the conference. We're gathering here today to examine how capital's deployed. And it's a global environment, as you well know, that's defined by volatility, fragmentation, and tighter liquidity. The backdrop is increasingly volatile. We've got conflict in Iran and the Middle East. We've got a war in Ukraine. We've got tariff turbulence. All these factors, plus many, many more, are creating immense uncertainty. Now, as markets recalibrate and long-term capital becomes more selective, large economies like India's are shaping their own capital frameworks rather than relying on global cycles alone. And India sits at the front of that shift. Now, today, we are leading in this room with all of you. There's going to be a whole load of capital allocators, policymakers, market builders. We're here to assess how capital is formed, allocated, and sustained at scale in a global world order. We are exploring capital as a force for tomorrow, not merely as a financial instrument, but as a bridge between ambition and action, vision and reality. Now, a few quick acknowledgements. Thank you to our sponsors, Nuvama as our association partner, the government of Maharashtra. We've also got our exchange partner, NSE, and strategic partner, Gift City. And a big, big thanks to the venue. Are we loving this venue? Big, big thanks to the venue, Quorum Club. Now, as if you didn't know, IGF is a vibrant, it's a growing, and it's a member-led community. If you want to find out more, don't be shy. Our team is everywhere. Go up to them. Please do grab them and find out more about IGF. Now, as a note, what's ahead? Our next event is UK India Week in London in June, 22nd to the 26th of June. The theme is financing the future of UK India innovation. We've got New York to follow. We've got Dubai to follow later in the year as well. If you want to get involved, please do speak to our program team. Just one final thing, and it's a very, very good reason to stick around a little later. After the Sanjay Sudhir session, last session of the day, the conversation is going to continue behind closed doors, for IGF members only. Big discussion behind closed doors. Now, this is the type of exclusive briefing that's just some of the perks, one of the perks of IGF membership. Earlier this year, in case you didn't know, our members were part of this fantastic IGF delegation hosted by Elon Musk at SpaceX Starbase in Texas. What a visit that was. And that's the kind of access that membership opens up. If that sounds appealing, you know who to approach. You can start with that man right now. Let's start with that man right now. It gives me enormous pleasure to welcome the founder, the chairman of India Global Forum. Big round of applause for Manoj Ladwa.
Thank you, Mark, for that wonderful and energetic introduction. Very much in the, can everybody hear me? In the IGF spirit. It's great to be here in Mumbai again this year. This is our third edition of IGF in Mumbai. And what better place? A place to have a conversation, the financial capital of the world's fastest growing large economy. And it's a personal pleasure for me because I spent 3 formative years of my initial career as a corporate lawyer in this great city. I have many friends here, some of whom are in this room and have been part of the IGF journey. So welcome to you, welcome to all those new faces and new friends that I've made and will be making over the next few hours as well. So friends, when we gathered here last year, the global economy was already shifting. Just before our forum last year, sweeping tariff measures from, guess which country? The United States, signaled something deeper than just a trade dispute. They signaled the beginning of a new global economic era. A year on, that shift has only accelerated. Trade tensions have hardened into structural realignments. Supply chains are being redesigned, not just for efficiency, but for resilience and sovereignty. Capital is moving more cautiously. We can see that from the markets. Pricing geopolitical risk in ways it really did before. Put simply, geopolitics is now shaping the markets as much as economics does. Yet amid the turbulence, one story has remained remarkably consistent. India. India has remained stable. India has remained decisive. Some would argue stubbornly decisive, but decisive nonetheless. And India continues to outpace all other major economies in the world. This year, India's economy is projected to grow just over 6%, nearly double the global average and significantly ahead of most others. India has also recently become the 4th largest economy. Would you imagine it? The 4th largest economy, overtaking Japan. At a time when volatility has become the norm, India has offered predictability. When fragmentation has accelerated, India has doubled down on integration. And when investors have searched for clarity of direction, India has and continues to provide it. This confidence reflects institutional resilience, macroeconomic discipline, demographic strength, and a long-term development vision that has been articulated so eloquently over the last few years by none other than the Prime Minister of India, Narendra Modi. India's story today is not simply about growth. It's about confidence. Confidence in institutions, confidence in markets, confidence in the country's long-term direction. But friends, we must also recognize the world that we are entering into. That reality. This is not the end of globalization. Friends, this is the reinvention of globalization. Today, capital must price geopolitics, supply chains must price sovereignty, and partnerships, very importantly, partnerships must price trust. The playbook that guided governments, investors, and corporations for 3 decades is being rewritten in real time. And yet, even in this environment, India continues to attract global confidence. Last year alone, India received nearly $50 billion in foreign direct investment. Still less than what I would hope for, but $50 billion, placing it amongst the world's most resilient investment destinations. In this evolving global landscape, India occupies a uniquely powerful position. She is large enough to matter, open enough to integrate, and independent enough to make her own sovereign choices. India can expand trade while strengthening resilience. She can attract global capital while building domestic capability. And she can partner widely without becoming dependent narrowly. That balance, that important word, that balance will define the next phase of India's economic rise. But at the same time, another transformation is unfolding. Artificial intelligence is moving from innovation to infrastructure. It will reshape productivity, industries, labor markets, and even geopolitics. As Mark mentioned, over the last year, I and several IGF members have had the opportunity to spend time with the leaders shaping this transformation, from Silicon Valley to global technology forums, including conversations with Elon Musk and Sam Altman. What struck me most was not simply the technology. It was the scale of the shift that's underway. We're entering a period where intelligence, I underline this, intelligence becomes the foundational economic resource. Countries that combine data, talent, compute power, and regulatory clarity will define the next phase of global competitiveness. And this is where India's opportunity becomes extraordinary. India now has nearly 1 billion internet users, the second digital population in the world. Its AI workforce, importantly, already numbers over 400,000 engineers and specialists, one of the fastest growing talent pools in the world. The question is no longer whether India will participate in the AI revolution. The question is how much. The question is how much of it will India shape? But technological transformation also raises an important question. How should countries govern innovation without slowing it down? The real challenge for regulators today is not simply controlling risk, it's understanding opportunity. Regulators today face an incredibly difficult task. Technology moves at the speed of innovation, while regulation, as many of us know and a few of us suffer, traditionally moves at the speed of caution. And I'm being diplomatic here. The challenge for all of us is ensuring that the gap between the two does not become the gap where opportunity disappears. Good regulation should not stop innovation. It should give innovation the confidence to scale. And that requires depth of expertise, institutional strength, and regulatory clarity. Capital does not fear regulation. None of you fear regulation. Capital fears uncertainty. This is particularly relevant in areas such as digital assets and crypto infrastructure, where clear frameworks will determine where talent, capital, and innovation choose to locate. But India's growth story is not only a national story, it's also a state-level story. States like Maharashtra, as we discussed last night over dinner with Chief Minister Fadnavis, are economic engines in their true right. They are where policy meets execution, where infrastructure meets investment, and where global partnerships translate into real projects and real jobs. Mumbai itself remains one of the world's great financial cities. a gateway for capital into India, and increasingly and importantly, a gateway for Indian capital to the world. Partnerships between global investors and forward-looking states therefore matter enormously, because the next phase of India's growth will not be driven by national policy alone, but state-level innovation and competitiveness, as we heard yesterday evening. India's financial future will also be shaped by complementary strengths in financial centres. While Mumbai remains India's financial capital, home to the country's largest banks, capital markets, and financial institutions, alongside Mumbai, another centre is rapidly emerging, Gift City in Gujarat. Mumbai and Gift City should not, and I underline, should not be seen as competing. They are, in my words and my view, complementary engines. Mumbai provides scale, institutional depth and market maturity, where GIFT gives India the opportunity to innovate in new financial structures with its regulatory frameworks, and above all, in creating new windows for opportunities for all of us to benefit. Together, Mumbai and GIFT form a powerful dual architecture, or in political parlance, a powerful double engine for India's financial future. One grounded in deep domestic markets, and others increasingly connected to new streams of global capital flows. And who better to bridge between these two powerhouses of Mumbai and GIFT than the newly appointed chairman of GIFT City, Uday Kotak. This is precisely where India Global Forum plays its role. IGF operates at the intersection of policy, capital, technology, and enterprise. But perhaps most importantly, IGF puts India's lens on the world, not simply asking how India fits into global conversations, but increasingly asking and challenging how global challenges look when viewed from India. And increasingly that perspective matters, because today India is not simply participating in global change, it is helping shape global change. So over the past 24 hours, from our engagements at the National Stock Exchange to the closed-door roundtables that many of you participated in the morning, one message I believe is coming out clearly. Global investors increasingly will view India not simply as an opportunity, but as a long-term strategic partner. Over time, friends, we also realize something important. These conversations cannot happen only for a few days each year. So we created the IGF networks, a trusted community of leaders, many of you who are in the room today, who continue these discussions throughout the year, in Mumbai, in Dubai, in London, in New York. Investors allocating capital, entrepreneurs building industries, policymakers shaping frameworks, global partners connecting India to the wider world. Because real collaboration, friends, does not happen only on stage. It happens through trusted networks and sustained engagement. Across the 2 days in Mumbai, we're exploring a defining question. What will global capital order look like by 2030? And what role will India play in shaping it? And all of you in this room play an important role in that. For decades, the world asked, how would India fit into its global order? Increasingly, the question now is how the global order will evolve around India. In a world where fragmentation is rising, India's opportunity is clear: to be a trusted, reliable, and competitive partner in the global economy. The conversations we have, friends, matter because they influence real outcomes. People watch us, people read us, people engage with us. Not only in Mumbai, in Delhi, and around the world. It's where capitals flow, where technologies scale, and where partnerships endure. So friends, thank you for being a part of this journey. Thank you for being a part of the IGF journey. Now, to open our first plenary, we turn to the central question. Who wins in the new capital order? Who better place to reflect on that than someone who has invested across cycles, across geographies, and across technological revolutions, literally. It's my pleasure to welcome a leading global venture capitalist, a philanthropist, and the chairman of B Capital, a guy that needs no introductions, Howard Morgan. Howard. I'll just get thank you ever so much. We are on.
Good.
You can hear Howard? Okay. I'm going to see if technology works, if this Apple revolution actually works for us. Yeah. Here we are. It's good to have you.
It's good to be here.
Excellent. No, thank you ever so much. And when Karan mentioned that there's a possibility of you joining us, we're all very, very excited because, as I said in my introduction, you have unique perspectives and a unique vantage. But let me turn to the first question that I had in my mind, is that it was 3 years ago that you last came for business. You've come once after that for a holiday. But 3 years ago, what was your impression of India, and what do you think has changed?
Well, Bombay has changed tremendously. I came last time to Delhi and Bangalore. I had been to...
Volume up.
Are we? There, that's much better. Much better. I came 3 years ago to Delhi and Bangalore. I'd last been in Bombay a few years before that, Bombay and Pune. And Bombay is completely transformed in those 3 years, from my perspective. What I see on the streets, the work that's been done, the public works, and also the strength that we heard of yesterday from Ashish with the NSC, and getting a country really filled with investors now who are interested in investing. That's a huge difference. In addition, the early stage venture market has grown dramatically. So those are both very positive.
What, if you just look at those, is there anything you think, well, India could have done a bit better on, Mumbai could have done a bit better on over the last 3 years?
I don't know about Mumbai specifically. I think the public markets could have come faster. The deregulation could have come a little faster, but it's happening now at a good rate. And we've taken a few companies public already of our India investments. We've invested over $1.5 billion in India in the last decade since we started B Capital, and we're now starting to be able to realize some of that, which is the most crucial thing in venture. DPI, money back to our investors.
Absolutely. Let's take the starship up and look back down on the world, and crisis in West Asia, China and the US decoupling, Trump's tariffs. There's a school of thought that all of this should structurally benefit India. Do you buy that, or do you think that's a bit overstated?
I do buy that. I think President Trump, forgetting about the illegal part of the tariffs as the court ruled, but President Trump has very deliberately tried to push the isolationist agenda, and that leaves a hole, a vacuum that India can fill, and is filling, I think. And I think we've seen interesting collaborations. The I2U2 collaboration that Prime Minister Modi joined means that India is playing a much more crucial role. And the fact that U.S. companies, because of the conflict with China, which is hopefully never going to be a hot conflict, but still, certainly an economic conflict, India has a great role to play in that.
Okay. So that's your reading of India. Give us a snapshot of your reading of Trump's USA today.
Look, it does not.
This is a googly in cricketing terms.
Yeah,
this is a googly.
No, President Trump has broken every norm of the U.S. and presidency, and all civility, etc. Some of it has proven to be positive. A lot of it has proven to be negative. And we won't know until the end of his term how much will last beyond that. And will we just sort of revert back to being pro-globalist, etc.? I don't think so. I think what he set in motion will last for years, maybe a decade. So we have to adjust to that new reality in international relations. In the U.S., he's taken the size of the federal government down quite a bit, with Elon Musk's help at the beginning, but he's such a fickle leader that you just don't know who's going to be there in the next day. We've seen finally a first change in his cabinet. In Trump 1, in the first term, he had very intelligent and experienced people in his cabinet, and they said no to him too much. And so he decided for Trump 2 he wouldn't take anyone in the cabinet who's going to say no to him. That has not a good situation for a leader.
And for our audience, they'll go back to their offices, back to their terminals, and they'll see all of this volatility. What would your advice be to them as to how do they bake in Trump's US?
Well, I started Renaissance Technologies with Jim Simons, a very successful quant fund. Quant funds are long volatility. Trump is wonderful for quant funds, because he creates volatility. He wakes up at 3 a.m. and sends out a tweet, and all of a sudden the markets move, and the quant funds I invest in do very well. So I would say, my grandson is running the volatility derivatives desk at Goldman right now. So he's having a great year.
Fantastic. Okay. Going back to India, look, you've seen multiple cycles of the India moment. What makes this different, or could it still derail?
Well, anything can still derail, but what makes this different is there's a lot of outside capital, but there's also a lot of spirit that I see, and I hear from the people in this room, the people we met the few days before this, and the spirit is that India is on the rise. India can have a global technology play more than just being the services arm, the customer support for the rest of the world. They can actually produce goods and services for the rest of the world, and for what is the largest market in the world, bigger now than China, and they can make that work, which will, with that GDP growth, you'll go from number 4 to number 3, I'm pretty sure, pretty quickly.
But what could derail it?
What could derail it? Well, political instability, I don't think you're seeing that. The oil crisis, obviously. Oil is a crucial resource for India, and if the crisis in what we call the Middle East, you call West Asia, if that lasts for too long, that could start to derail it.
Okay. Going back to let's move a little bit on to you as an investor, and the post 2022, you saw that re-reckoning between governance and profitability. If you look back over this last period, what are those bets that you made? You think, well, actually, I think I made the wrong bets here.
Well, one of the issues that we've found in India and Indonesia and places is we have to be more low trust. We have to verify more. So it's more costly to invest. Our due diligence costs go up. We have to do much more forensic accounting in the companies we're investing in because we have had some negative situations with that. And that has been difficult. But we found some great companies in the AI space, in logistics space, and even in marketing technologies, all kinds, and education here with Banju. So I think we've done some really good things, but we've been burned a little bit, and so we're much more cautious now.
Yeah. So you mentioned that magic word, trust. I mentioned that earlier on as well. What's your trust index or matrix? What are the few things that you look for specifically that perhaps are not quite the obvious?
Well, we have in our headquarters in Singapore, my partner Eduardo Saverin, our co-founder, he's built a really big AI team. We have 7 people doing nothing but giving us AI. And what he will do is tell the company, we want to see your detailed financials, but also we want to see your actual detailed revenue every single order and so on, and he'll run the AI on that. And in one case, the AI came back and said, "This is not real. This is fraud. This would not be a pattern we would expect." So we've had to use the modern tools, AI in this case, to do a deep down analysis of companies.
And specifically on startups, the Indian government, as you will know, has put a lot of emphasis upon evolving a startup ecosystem in this country, and to great amount of success, and most recently put a huge amount into an relative to India, a huge amount into an investment fund. And you'd have seen that other countries have sought to engineer innovation ecosystems. What's your lens on that, your advice on how the government would be structuring it, where would it position it, to make it most effective?
Well, I think to make it most effective, and back in '96 with Bill Gross, we started IdeaLab, which was the first incubator, is to put money in where there is a great concentration of university talent, where you have the IITs and the IIMs and your sort of top tier universities, which are world class in any way, and make sure that you have a mix of both. India is known for the engineering talent. You need the management talent to go with those engineers. And increasingly, if the engineers were just coding, you don't need them. So you really need the business people who understand business. And I would think that if their funds are careful and making sure that they don't invest in a single individual, but they invest in a team that has both management and business expertise as well as the engineering expertise, then they can be more successful.
One last question. If you look at 2030, let's look a little ahead into the future. And if there was one bet on India that you would make that our friends in the room may have missed out, may be missing out on, what is the Howard Morgan bet?
Space. I think that we've invested in space technology in the U.S. With my partner Karan and the team. We've started to look at a number of space technology investments. India has started to become on a par with anyone in the world in that area. And I think because of the cost structure and other things, that's a place I would look.
Oh, fantastic, because we're on the same page then. It's with IGF, as you've heard, we've engaged with SpaceX quite extensively, and with Elon twice now, personally as well. So we're seeing that as well. So watch this space, everybody. Right. I'm really disappointed. They're saying time's up now. Hasn't he been absolutely brilliant, his insights? So please give a big round of applause to Howard Morgan. Thank you so much.
Thank you so much.
And thank you ever so much for joining us. Thank you. Thank you. Thank you very much. He mentioned he's going to come by, so thank you.
First panel discussion of the day. Give me a little wave, just to see you're all still with me, spiritually, physically, physiologically. Right, let's do it. Let's get our three guests up here. Big round of applause for Amit Chandra, Chairperson, Bain Capital India Advisors. Amit, come and sit next to me. Oh, you're sitting there, wherever you want. Vani Kohler, Founder, MD, Kalari Capital. And Radhika Gupta, MD, Chief Executive, Edelweiss Mutual Fund. Here's Vani. Come and sit down. Good to see you all. Hi, nice to see you. You're using handheld microphones. Just hold them up closely to your mouth, to your lips. Thank you all for being here. Lovely to have this half-hour discussion. This is all about capital allocation. It's called Capital Insight, so it says what it is on the tin. Before we delve into the world of private equity, retail, and venture capital, which is their individual expertise, it's fascinating to see what's happening. As Manos just said, a lot's been going on, in case you haven't switched on the television in the last 10 days. We've got this Middle East crisis. It's the most significant military escalation since 2003. Oil is crazy. I mean, yesterday morning, 90, 120, back to 90. I mean, this is wild. So if you're long vol, as Howard Morgan is, you're doing well. We'll see if our guests are long volatility. We've got the Strait of Hormuz essentially closed, and India, well, it needs a lot of its oil. Half of its crude, I've seen 40%, I've seen 50%, the experts will tell me, comes through the Strait of Hormuz. Can I just start with you, Vanny? I'm just going to go down the line. Let's start with this big elephant in the room. How has it changed your thinking when it comes to thinking about capital, what you're going to be doing with capital, planning capital? How has the last 10 days shifted your thinking, Vanny?
Not a lot has shifted other than at a personal level a deep concern, but that's not not for myself, but for the world at large. But that's not the topic here. In the last 40 years, obviously my generation didn't see the world wars, but in the last 40 years that I have been professionally engaged in the world of startups, many cycles, of course some of it is market cycles, some of it is technology cycles, and conflict cycles come and go. They don't matter if you take a long-term perspective. They do matter if you take a short-term perspective. So based on the nature of your business, that is the muscle that you need to have. And of course, short-term and long-term can all be relative depending on the product, the asset class, and of course that particular conflict. So I hope the last 10 days conflict is not a sustained, drawn-out, 4-year world conflict and gets solved.
Yeah.
And smarter minds and experience should teach us that we should solve it, but I understand logic doesn't always play out in reality. But for my world, which is really venture capital, and by preference we like to be a lead investor in something very illiquid, which is technology startups at their first institutional capital raise. And our companies anyway take 7 to 10 years to exit for us from time of investment. So unless this blooms, not blooms, that's a wrong word, right? This, becomes something that's very deep and drawn out, I am assuming that we will not be impacted by this cycle. We have the capital to invest, we have the commitment to invest. So, ask this a year later if it's continuing, and the answer might change.
Yeah, Radhika, what do you think? Long-term cycle, Vanny says. She's got the sort of 7 to 10-year horizon. Conflict cycles, they do come and go. And often, if you buy the news, it passes quite quickly if you look across asset classes. So she has a long-term perspective. What about because you're the retail market, you see the retail flows. What can you tell us about the last 10 days and your perspective on capital allocation?
So firstly, it's great to be here. And, I sit between Vani and Amit on this stage, and I represent a world where the average consumer is probably putting $10, $20, $30 of capital. And we have something called an NAV that comes out every 24 hours. So this is a bit of the reality of my existence. Now, the news I have, I think, is largely good news. So I would look at it from two lenses. One is the lens of public investors and consumers. And I think that lens has been extraordinarily resilient. I mean, if you look at half of India's equity investors, they have entered the equity markets in the last 4 years. And these last 10 days are probably their deepest experience with volatility. Despite that, and the mutual fund industry numbers for February just came out, and I'm sure they'll come out for March in due course, investors have remained very, very resilient. So your common retail investor, I mean, it would make you very positively surprised that I haven't answered any questions in the last 10 days. And I think that speaks to the maturity of the common Indian investor.
Can you give us just, are you allowed to tell us any numbers in the last few to 10 days?
Yep.
As you say, it's small amounts of money, but it adds up, and we'll talk about that.
So, I mean, India has a systematic investment book, which is monthly investments of about 30,000 crores, or about $3 billion. The February numbers are the same. February numbers for the mutual fund industry were actually 10% higher than January numbers. And the last few days of March have actually been better for us than February. So people are actually using this correction to put more money into the market in aggregate. I mean, my numbers have been 20% better from a consumer point of view. So I think that reflects rising consumer maturity, and that's good. I think the second part of us, the perspective is as a custodian of capital. And of course, while we are a daily NAV business, not the last 10 days, but what the last 4 or 5 years have made me realize is that our notion of market cycles in India has to change a little bit. It's my belief that market cycles in the world that we live in have gotten shorter. We used to live in an era where volatility was a sprinkle, geopolitical events were a sprinkle. They've become business as usual for us. And what that means is market cycles have just gotten shorter. They're not 8-year cycles, they're 3-month cycles, they're 6-month cycles. So as asset managers who manage public money where there is a daily NAV, you need to be a lot more nimble in your investment approach. So the traditional biases that you would have towards value or towards growth or a single style or a single sector kind of have to go away. And we made this decision 4 or 5 years ago. And we're just a lot more nimble in our investment approach.
Yeah. Where do you stand, Amit? Private equity is your thing. Are you nimble like Radhika, or are you looking long term? Where are you sitting, given the geopolitical backdrop?
Mr. Private Equity's just entered. Manish, maybe he should answer it.
He's not nimble, no.
He's commenting on my size now. Look, I think India's matured a lot. We've come a long way from the crisis we had at the Gulf War, etc. I mean, we're a very diversified economy. And therefore, I think we are very differently positioned at this point of time. And I agree with both what Radhika and Vani said. Our ability to weather a crisis of this sort, unless it becomes deeply structural, in which case the whole world is going to have a big issue, is really, I mean, resilient is the word that comes to my mind. And I think, if anything, people are going to use this as an opportunity, if there are dislocations in the market, to put more money to work. We own the largest wealth manager in the country, and I was looking at it over the last week. The stock is up and not down. That's just one indicator. But look, we also forget the fact that while Indians domestically have put a lot of money into the markets via the SIP, the product that Radhika spoke about, but also into direct equity, about 45 billion a year average over the last 2 years. The other big story about savings in India has been that Indians have invested about 400 billion on stock value into gold. Today, the value of that on the market value is close to $1 trillion. That's one of the biggest wealth creation events in market histories. And so we are actually sitting on a massive unmonetized, wealth creation phenomena. And that provides a great cushion to investors in this country against any form of event. And this is all happening when there's all kind of geopolitical stuff happening anywhere else. This is completely tradable. It's largely tax-free, etc. So I do feel that this is my 32nd year in the markets, and in past many crises have been very spooky. I think this one, everyone's looking at this with a lot more, kind of Buddhist feelings to it.
Yeah. I want to step back and just give you a sense of where the money's flowing, where it's left, and then we can delve into each of your expertise. If the numbers aren't 100% correct, please say, Mark, that's rubbish, and give me the real numbers. But these are the numbers that I discovered. So India's household savings have been flowing into markets, record highs, now above 30,000 crore a month. That's through SIPs alone. So that's brilliant. Foreign investors are pulling out right now, 1.58 lakh crore from equities last year. That's the largest outflow on record. So you've already got a divergence there. Now, private investment, private equity, venture capital, money coming in, it is recovering. We had 26 billion in the first 9 months of last year. That was a 3-year high. But the money coming out through sales and listings has dropped to 11 billion, which is a 4-year low. So what we've got here is capital coming in, but the door marked out is getting narrower. So 3 different pools of money, 3 completely different stories. Radica. So households are buying, they're absorbing all those dollars of net selling by foreigners. Is it sustainable? Can Indian investors carry this market on their own, or do we need foreigners to come back?
I think I should tell you, I answer this question once every 3 days. So by now I'm very well trained to answer this question. So if my answer sounds boring, then
no.
I've answered it a number of times.
We need it.
But it's an interesting question.
Thank you.
So I think financialization, which is something that you have seen in other parts of the world. If you look at the experience of the US in the late 80s, or China in perhaps, a decade and a half ago, is a real trend. And I think financialization today is real, as I see it from my lens. The Indian household, if you go back to the 1990s, was a very, very risk-averse household. When someone of my parents' generation wanted to make an investment, it was a traditional investment in something called the post office, or gold, or physical real estate. And I think a number of catalysts have made financialization a structural shift, not a speculative shift. Part of it is, of course, the underlying performance of the equity market. I mean, India has been the second best equity market after the US. Part of it is the taxation structure that India has, which really favors risk and equity-oriented investments. Part of it is digitization, which has made all this equity investing and mutual fund accessible to tier 4 and tier 5 of India, which is an extremely exciting story to talk about. And part of it is, I think, a lot of government push around financialization. Our industry has run perhaps the world's only common campaign. It's called Mutual Fund Sahi Hai, or Mutual Fund is Good for You, where everyone pools money together, and we have an 800 crore annual advertising budget to tell consumers that this is the right thing to do. So the catalysts are there, and the catalysts are real. Now, is this 100% structural and 0% froth? I don't think so. If you were to ask me if you had a sustained period of downturn, would 5-10% of this go away? Probably yes. But it's a total contrast to other parts of the world where income-oriented strategies have been in favor versus growth. So my view, this is strongly structural for a number of the reasons I mentioned. And by the way, even after all this good stuff that I should be proud about, how mutual fund AUM or equity AUM as a percentage of GDP is still about 25% of the world average. So there's a long way to go.
How quickly can we get there then?
Miles to go. I think we talk about Viksit Bharat 2047. A great objective would be to see 50% of our population actually participating in Indian capital markets. That number is about 20 crore today. That should go to 50 to 70 crore.
Yeah. Vanni, let's come back to venture. The total money going into Indian startups went from 38 billion in 2021 to $11 billion last year. That's a bit of a reset, more selective, smaller checks, founders being told to prove they can make money before they can grow. They need to find discipline to grow, discipline producing companies or producing better companies. Is India, what's the appetite for risk? I mean, no one knows that better than you. Is there appetite for risk to really want to produce genuinely world-class businesses? What would you say?
Well, there are two different questions. One is about, is there a downturn in venture investing or PE investing? And is that cyclical? Is it systemic, right? If you go back to 2008 and then 11, there are cycles that even in the last 20 years that I have been part of this ecosystem here in India, I can point to 3 prior cycles where there were dips. So by itself, those are corrections for liquidity and other things, right? So the gap that you're talking about, I see that as a cyclical corrective cycle, not structural. Again, unless there are other catalysts that force us all to make some foundational structural changes. We don't know that today. So we can't call that without more data that would indicate that's necessary, at this moment. But your second question comes up so often, is there risk appetite? And honestly, I don't understand that question at all, though we get asked that all the time, because I feel that venture capital is all about risk, and founders also blame us for not having risk appetite, but it is not unmeasured risk, right? It can be liquid, there can be a cycle, but everything is about understanding the risk and having a framework or a model to adjust that risk to return. And that principle works for everything. It doesn't matter if you're a day trader or a long-term illiquid investor like venture capital. So I'll put it this way. 20 years ago, I couldn't have seen the kind of deep tech companies we are investing in today. 5 years ago, we didn't see these companies, these founders, and not just the founder, the market maturity, the technology maturity, where you could solve certain problems and create certain value equation out of it, right? So the risk a decade ago for certain kind of investments were very different than the risk today. So the way I look at it, there is a lot of capital allocation going into innovation. Even earlier today, there was a question, why haven't we created an Anthropic? And this goes on, right?
Does that sort of question bother you? Why can't you?
No, it bothers me because we expect somehow that these are easy answers. They are not. They usually have structural systemic issues. If we needed to have created Anthropic, we would have made certain investments 20 years ago, not as a venture capitalist, that too, but systemic investments. It's not any one catalyst that ever changes the market, including equity market, like Radhika just described. There are many catalyzing forces that creates that perfect storm, right? Movement, we know that. So, but what I am encouraged by is the systemic, collective changes, enthusiasm, capital from research, academic, industry, and entrepreneurship, capital markets, for collectively creating innovation ecosystems. So it's not just about risk investing. You have to create many other structural safety nets before you can do the risk investing. So the good news is it's happening today, and it didn't happen 20 years ago.
Yeah, and I'm going to ask you to look ahead. You were looking back 20 years. We're going to ask you in a minute to look to 2030, and I need solid predictions. Amit, money is going into private deals, like we said. Investors, though, finding it much harder to sell, to get out. What is it, a timing problem? Are the right moments to sell, are they coming? Or is there a deeper gap between what people paid going in and what they'll actually get coming out?
So, Mark, actually, people aren't finding it hard to sell. Part of the reason, going back to your earlier question, that we are seeing net FDI and net PE flows shrink is basically because India is a market where people are finding it harder to deploy capital than to take out capital.
Right.
So if you look at all the top 10 investors, you'll find that we've all been able to sell companies much easier than we've actually been able to deploy money in. And so it's actually very simple, by the way. The arithmetic is for every dollar we invest, we typically make $2 to $3. And we do so between 4 and 7 years. And therefore, when you look at the curve, you'll find that whatever is the shape of the curve, you can actually you can predict the shape of the exit curve. And that's why, at this point of time, net PE flows and therefore net FDI flows are looking anemic. The only way you can offset that is do two things. One is your inflows need to increase at a rapid pace. And the reason why inflows haven't increased is basically because of a supply problem. CapEx hasn't increased in India. We all know about CapEx has basically been quite anemic. And second is the Indian promoters have found the capital markets as a much more viable option to go and seek liquidity from than the private markets, which wasn't the case 3 to 5 years ago. And that's the reason why, part of the reason why your PE inflows have looked anemic, and even more so on a net basis. So what will change in this is either a revival of the, of the CapEx cycle, or the market valuations looking more modest, and therefore people seeking, to go to the private equity folks as opposed to the capital market. So I think that might happen, but it's probably, a year or 2 years away. There is a lot of dry powder. When we look at the dry powder available for India, we think that there's at least about $100 billion available to get invested over the next 3 to 4 years. So there's no shortage of India's focused capital available outside of India. There's a separate question whether is this what we want, or is this what we should want as Indians? I go back to Radhika's answer. Even today, the total Indians own 6% of Indian equity. That is it. What we should want is different from, what we are talking about.
Yeah.
We need Indians to own more of India. And what's been happening actually structurally is great for us. Unfortunately for us, we run a fiscal, we run a trade deficit and therefore current account deficit. And so we need foreign inflows to come in. Until we address that problem, this is something that we are dependent on. But I can tell you without doubt that, at least for all the policy work I do, I'm very clear that India needs a much more vibrant domestic private equity industry, which substitutes over time some of the flows that we've had from the foreign investors.
One thing you need from the government to make this happen. Go.
Oh, we've... today we have a structure where public market investing is favored over private market investing virtually, right? So we need to, for example, create a risk framework where we actually favor private market investing, taking risk over the long term. We used to have so in the past. We need to bring that in so that ultimately people basically take long risk. They encourage entrepreneurship, because ultimately these are if you want companies like Anthropic, etc., to get created in India, you'll have to encourage people to do that. So I think the government is cognizant of that. We have some things which are happening at this point of time. We are going to see fund of funds getting created, getting funded, etc. So this will happen. It'll just take a little bit of time.
Yeah, let's look to 2030. We've got 9 minutes, so get your 2030 hat on. We're looking ahead to 4 or 5 years' time, the outlook, the capital outlook, what we need to get there. Radhika, what's India's role? Put your 2030 hat on. What's India's role within the global capital landscape? What does it look like in 2026? And what do we need to maybe get to the place which you see as the best case scenario?
So I think I've spoken enough from a consumer point of view. But I think, of course, India is going to be a very significant and large capital market. And the one thing that we need is just a larger universe of high-quality listed companies. There's no point in large amounts of, Amit spoke about domestic private capital, I spoke about domestic public capital. But if that capital is finally chasing 100, 250, 500 companies of size, then we do have a problem at hand. We actually need 2,000-3,000 good quality, high governed listed companies for people like us to be able to invest in. And, as I think to 2030, I mean, finally, we're talking public and private. Both of those intersect because a balance sheet is a balance sheet and companies are companies. So we need more companies from private markets that list and build scale with sustainable financial business models that work in the public markets. The second one, I think, being very, very important. We need to constantly work to improve our standards of governance, and we have done a lot of work there as a country. But I just remember the talk that Howard had, especially when global investors look at us. Every governance failure, I think, is a mark or a question on India. So I think we need to work harder on governance. And the third one, which India is, in all this anthropic debate, it drives me crazy too. I think one area that we've historically been weak on as Indian corporates is R&D. We've lagged behind R&D spends compared to an Israel, compared to a China. One of my criticisms in the past is that we've had a stock market that's done well, but companies can't exist to serve the stock market. So there is something called too much return on equity. And when you have cash and when you have capital, I don't believe you should be doing buybacks and dividends. I believe you should be investing it in R&D so that 10 years later, you're not asking the anthropic question again. So I think companies of 2030 will be the ones that put the serious spend in R&D, and we can afford that as a nation.
Fanny, 2030, what does it look like? What are the companies that you're investing in, want to invest in? What do they look like? What are the winners? Put your 2030 hat on. You've got 2.5 minutes each.
So 2030 is actually not that long time off. That's not that far. So since my enthusiasm is what and how will India shape the innovation economy, and that's always has to be seen from a much more longer horizon. In 4 or 5 years, can we at least take confidence, and I think we can, that we have created for the, let's call it the global south, a model for what innovation economy companies can look like, right? And there are a number of areas where India is already leading in certain aspects of that. And the idea is not to compare an Indian company with Anthropic or something else, but we have to look at our markets. Our markets are really the global south, and that requires value, affordability, accessibility to be driven for a larger population, and that has its own innovation engine that's relevant. And whether I see robotics, medtech, biotech, energy transition, and many other areas, there are real problems to service the, let's call it, 7 billion people in the global south versus the 1 billion people of the global west from income, affordability, and so forth. I think we have a very real shot in showing that we can be a leader in the innovation economy there, right? So that would be my hope and expectation that we can do that.
Hope and expectation, Amit. Give it to me. 2030. Go.
We are in the era of global fault lines. And I think the opportunities will lie in these crevices. If you look at what's happened in the US, today 40% of the market value of America did not exist 25 years ago. I think expecting, going back to Radhika's point, the only time I'm going to disagree with her, expecting our elephants to dance is not going to happen. I think the road ahead lies in new players who are going to, give these elephants a run for their money. I think there's going to be, we'll have to think about new innovations, disruptions, and figuring out how to deal with these global fault lines. The fault lines could be geopolitical, the fault lines could be energy intensity and how to deal with it. It could be climate change. It could be, everything emanating out of AI. Each one of those challenges will be an opportunity. And I think there will be new players who will make the most out of it using R&D and innovation. And out of that will get created new companies and interesting opportunities, just the way it has happened in the US. And I think that's where hope is. And the hope lies in, people who are 20 years old today and 25 years old today. I think we have to watch out for them.
30 seconds each. I give you a big sum of money, which you've got to hold till 2030. Give me how much money? What do you reckon? $100,000? Million? Million, right. $1 million. I give you $1 million each. You've got to hold it in one asset, one investment, till 2030. What is it? Boom, boom, boom. Go.
A space tech company that we are very excited in.
Yeah? Can we have the name? Or not? We're on to a space tech company you're very excited in. Okay, good. Radhika?
Indian mid-caps in hospitals, hotels, and capital markets.
Okay. Hamid?
I'll go short on oil.
Yeah? Short on oil. How low is oil going?
5 years from now,
yeah.
$50.
$50.
And I can buy that put really cheap today.
Is Trump around in 2030? He's not, right? There you go.
not that.
That was brilliant. Thank you so much. Can we have a big round of applause for Radhika, Vani, and Amit? Thank you so much. Let's get a photo taken. And then we'll move on to the next discussion. Thank you very much. Thank you. You're going to stand there, yes? Yeah? Let's take it. Can I join? Am I allowed? There you go.
You're like 5 feet taller. Yeah. And me next to him. We should do this differently.
Okay, thank you so much. Thank you very much. Brilliant panel. Right, we're moving on swiftly now. We're going to have a quick word from our sponsor, Nuvama. Please watch this short video. Founder, Chief Executive of 4 Line Capital. Let's get Dhruv up to the stage. Here we go. Let's build up some. Yeah. They want a quick coffee. We'll get them back in.
Thank you so much. 2:40 p.m. is the snooze session, right? So
or Mike.
Can you hear me?
Perfect.
Superb. So we'll call on stage Mr. Kejriwal, Naren Shah, and Karthik Reddy. When I go to conferences, the 2:40 session is exactly the one I skip to take a little snooze. So, no, but I'm very happy you guys are here. We'll make it fun. We'll make it entertaining. We'll make it interactive. So, it's great to have three esteemed panelists. Karthik is from Bloom Ventures. Naren is from Norvest, and Mr. Kejriwal needs no introduction from Kedara. All private markets investors, but as you've seen over the last 3 to 5 years, the private and public markets are starting to blend as many of your businesses have now entered the public markets, and therefore you have to be cognizant of both. The way I thought about structuring this session is we'll start with diagnosing kind of where we are in the market cycle. Each one of these three esteemed individuals have been investing now for almost 2 decades, if not longer, and therefore will have really interesting insights on kind of where we're at. We'll then get into how portfolios are being positioned. I'm sure this is of interest to many of you in the room, both from a personal investment standpoint and for the organizations that you represent. And then we'll end with a little fun session where we'll talk about one, I call it the make-a-wish part of the session, where you'll make one suggestion to the Indian government. Could be a regulator, could be a ministerial body, where you'll say, this is my one wish that I would, in an ideal world, like to have, which can really help spur capital coming into India and kind of help make your lives a lot easier. So I'll start with kind of where we're at in the cycle and then open it up. I read this morning, Akash Prakash from Amansa Capital wrote a note where he talked about a derating of the Indian multiple, right? This Indian multiple has been built over 25, 30 years of trust, underwritten by both domestic and foreign investors, anticipating both strong earnings, high ROEs, and strong longevity of earnings. How do you view this multiple today? It's clearly been challenged, right? You can see we're at a time in our cycle where fundamentally things seem to be on the up. Credit growth is strong. You've got good liquidity in the banking system. It seems like the velocity of money is good, consumption is doing well, IIPs are strong. So fundamentally, the India story seems to be doing very well, but very clearly foreign investors have gone very bearish on the India story. So it clearly means that the multiple has come under challenge. So maybe I'll start with you, Mr. Kejriwal. Why don't you give us your sense on kind of where we're at in the cycle and how you view this multiple going forward?
Thanks for having us here. Thanks, Dhruv. When you look at this as in your words, a 25 or 30 year cycle, at least as far as our world is concerned, and I don't want to pontificate on the macro or the public markets, and Akash and I work together, he's much smarter than I am, but I will tell him he's wrong. For me, if you look at private equity, they were literally, if you look at the last 3 decades, the first decade, 95 to 2005, was one where it was a monkey throwing darts. We didn't add value. There was a plethora of capital. The good thing was there was something called beta, a rising tide raises all boats, or whatever that stands for. So we all made a bit of money. 05 to 15 was the tough period. Lots of money was brought into India because of the promise and the so-called performance. People thought was alpha, but it was actually beta, and it was a disaster. There was no DPI, there was no returns, broadly. If I look at the last 10 years, I see a ray of hope for the industry. I think you've had a plethora of players, each following different strategies. You've got a lot more depth, whether it's early stage growth or late stage. I think people are actually truly, at least, okay, I think it'll be bimodal. The winners are definitely adding value. They're taking on, in addition to investment teams, taking strong operating teams. I think you've seen the result in DPI. I used to joke in 2015, we didn't know what the word meant. Now there's actual strong DPI, and across the board, not just in a few firms. So that's been good. So yeah, I think if you start, the good thing on private markets is you can fall asleep for a bit and come back 6 months later. Poor Akash is looking at the markets 5 times a day, so does not have the same luxury. But on a serious note, I do think, at least as far as we are concerned, I'll keep my comments to that rather than pontificate, was, yes, I think a lot of the money made 10 years ago or even 5 years ago was multiple expansion. I think today, if you go to any investment committee that we chair, there's absolutely no multiple expansion that you build in. It's purely revenue, EBITDA growth. Your returns have to be justified by real EBITDA growth with constant multiples. And actually, what I've started doing now is actually insisting on a base case, which is, at least in industries like consumer, which have a tad of a multiple compression, and then a bad case, which has significant multiple compression. So I do think we, as private equity investors, should not be hoping for beta. The world has changed. One, the environment has changed. Secondly, the competitive pressure has changed. So, and also given the pivot away from China, a lot more money has come into India, a lot more money chasing the same deals, and hence the valuations have gone up. So what I'm cautious about valuations, so you think of multiple compressions, even if the economy, I believe, is doing well, and we're having growth, but if you want to earn your earnings, you've got to make sure that you're driving the change in control or non-controlled situations and not leaving it only to the promoter.
Very interesting. Karthik, in terms of, one often cited reason for this, bearish story in India right now is fundamentally our competitive edge was labor arbitrage. If you look at all of our export competitiveness over the last 20 years, pharmaceuticals to IT services, it was all labor arbitrage, which is obviously now being questioned in this age of AI. As someone that's looking at companies a lot earlier in their life cycle, obviously in the public markets, it's very hard to find good candidates for pure play kind of AI exposure. But are you seeing good companies come out of places like Bangalore that are tackling this problem head on?
So very early, I think if you look at our right to win as venture capital, we would never play, like, let's say, the labor arbitrage game per se. You would play more of a intelligent labor force kind of a game, if at all. And even there, I think in both, when trying to compete with the US, there was a little bit of that, where our software or robotics or our SaaS companies were essentially saying, we can build that much cheaper in India. I don't think that's an advantage anymore. So your labor force has got to be as competitive as what you have in Silicon Valley, which means we are finding founders go to the Valley earlier and earlier and establishing a workforce, however small, and that's the advantage of the AI-first workforce. You don't need hundreds of people, you need tens of people. But the cost tabs will go up, but I think so will the potential upside from those kind of opportunities. The flip of that, which is building in India for India, I think that advantage has always belonged little more to the tech world than the legacy players. Because when you think of the problem or the solution set from a technology first lens, you have an advantage of potentially building, it's too early to say, but some of the biggest lenders or the NBFCs or the banks of the future might come from tech-first companies. We've not seen that in the last 15 years, so you can't blame the room for being skeptical or cynical about it, but I think it's just on the verge of happening. And I think that gets accelerated where you have a lot more advantage against the legacy players who may or may not, they might move processes and systems, but I don't think they can rebuild their entire businesses ground up. And I don't think it'll apply to necessarily process intensive or capacity intensive or capex intensive businesses like pharmaceuticals, etc. But I think for anything which is knowledge based, I think the advantage comes back even further to technology. First sort of founders who are building, like as someone said recently, an AI first company is one which has 2 CTOs and not a CEO, right? And so essentially that's the speed at which you need to evolve to be able to be globally competitive or beat the Indian sort of incumbent, in my view. So we're beginning to see signs, but I think it's too early for us to say we're winning or we are seeing potential unicorns in that space, or we're seeing 10-person, $10 billion companies. I think it's too premature, but I would love to say that 2 years from now or 3 years from now.
Where in the stack do we have a right to win? So Jensen Huang described it as kind of the 5 layers: energy, real estate, memory, chips, applications. Where in that stack does India have? I don't think we'd really be able to train foundation. We don't have the capital intensity to be able to train foundational models. But
I agree with you. I think it's a debate that's been had. I don't think we need to revisit or rehash anything, but just go all out to win the application layer, to be honest. Within that, I feel like, we index way too much on language alone, because it's come into common parlance that all of us now know how to engage with the consumer LLM, and so we think that is the only AI that's out there. But there's a lot that's happening on the hardware layer, the vision layer. So this is truly deep tech in that sense. Was happening before ChatGPT broke in. We have, for example, agri-robotics company, which has struggled in India, but is hitting it out of the park in California right now. So essentially, these kind of areas I think are being, not looked at deep enough in my humble purview. So when it comes to automating, workflows, agriculture, etc., space, I think we have a fair shot at building some really great companies from a global lens perspective. India per se, I think, as people keep reminding us, though we look like one unified nation, we are like complex in terms of our demography, our geography, our ability to reach various populations. So I don't think it's easy for a foreign company to come and win necessarily here, other than basic, standardized chat. Any application on top of that is our right to win, I would say. Just as a Walmart had to buy a Flipkart to be able to actually make a dent. I know that's a physical business and you're saying, is it apples versus apples? I think it is in some sense. I don't think it's going to be easy for them to come and build a economically viable option. And as somebody pointed out earlier this morning in a different conversation, I think the UPI moment for AI will come to India in a couple of years. And that will be very difficult for the Visa Master equivalent to come and eat our lunch. So we have to reimagine how we will solve for India at every layer. And that could be at the financial layer, the language layer, at the health layer, at the entertainment layer. So I don't think that is something someone can come and build expensive in India and expect the customer to pay a premium. I think our ability to pay is always capped. And to build within that is the opportunity and the challenge that only Indians can solve, in my view.
Very interesting. Naren, 2 questions on the growth equity side. One is, there's been a plethora of capital that's come in from the SoftBanks and the Tiger Globals of the world that are now bidding up a lot of these growthier companies. Do you feel like it's the adequate amount, we have enough of an investable universe in that part of the segment of the market, or is it too much? And then secondarily, 24 and prior, anything that you took public, you were getting pretty solid premiums on listing. That has become more challenged over the last, call it 15, 18 months since September 2024, which is when, liquidity has really been challenged in the markets, the stock markets specifically. So how are you viewing that dynamic? India's been seen as a bastion of exits, DPI, as Mr. Kejriwal pointed out, amongst all major markets in the world, very few are actually delivering that DPI. So would love to get your sense on both sides of that spectrum.
Thanks, and happy to be here. I think that at this particular point of time, since we play, so what's growth equity? Basically, I would say checks of 30 million to 150 million. People will have different definitions, but that's what we play in. At this point of time, we actually don't see Tiger, SoftBank, or any of the crossovers really there, and we do think there's still enough supply of capital. So I think that it's a sector or space. It kind of sits between venture capital and private equity. So we're not doing the big bulge buyouts like Manish might be doing, or a lot of VC like Karthik might be doing, but we're in the middle somewhere. So that space, I mean, we like that a lot, and we try to sort of play across sectors in that space. I think there's enough capital. We never not find competition, but at the same time, there are adequately sort of interesting, investment opportunities which you can maybe take IPO in 5 years, which is what our mantra is. So that's what we do. In terms of IPO, I mean, I'm just sort of taking it back to what Manish said earlier as well. See, I think there are 2-3 things which are changing, right? Earlier, what happened is, if you took something like a CPG pack, you had like these 10 or 15 companies which were there forever, from Unilever to Dabur to whatever, right? So what happened is there was not that much which was changing. There was not much being challenged. And so if you just threw a dart at that pack, somewhere between 30 and 50 times EBITDA would stay, and it would stay forever in the public markets. I think what's happening now is, and keep in mind we were $1 trillion sort of, economy, where now, or we were actually $500 billion, and we're now trying to go to 8 trillion. So as time goes by, there is a lot of new companies which all of us here are funding with, as Amit said, new thinking, right? And so these companies, as they go towards and compete head on, some of these companies will not do as well, and some of those companies will not do well, and you will get a divergence of multiples. I don't think you can look at averages any longer. So I kind of differ in the thinking which you mentioned, Akash Prakash, and huge respect for him, that it's just coming down. I think there are 2 things happening. There's a divergence, and you have to pick. And please understand that the world where if you want to just pick an economy and play on it, then you should go to Africa or something. This is not the country to be any longer. You have to pick the stocks. And then the second thing is just supply demand, right? Look at the amount of withdrawals from foreign investors. It's not because of India. It's because they've had to go back to their home market for many geopolitical reasons which we all understand. So at some point of time, some of this geopolitics is going to clear up. And that's our job, right? We look at the long term. When that clears up in a couple of years, whatever happens, it might be much shorter. I think the war could end next week, who knows, right? At that point of time, when the capital does find, looks for, as they call, we're an emerging country, we call it more risk capital. At that point of time, just imagine the number of stocks here are still going to remain the same, right? And the number of sort of the capital which is going to overflow into it, that multiple. So every time I've seen about 4 or 5 cycles, I focus on certain spaces. I mean, every time we see a cycle go a little bit down, there's always gloom and doom, right? And it's our job, unlike public market investors, to look through that and take contrarian bets. So my 2 cents here is that, look, we may not get to those egregious multiples where there were 2 companies and so they did that. I think you'll have to find companies which are differentiated, which sort of deserve a certain multiple, but I think some companies will always deserve that multiple the whole market won't. Now, in terms of going public and things like that, the only answer I have to a lot of people around the world is our markets are open, US is not, right? So if you want to go public and you want a really egregious price, you shouldn't go public, but at least you can. You had a choice. Which other market is open? So it's very nice. We're normally very good and very critical of ourselves, but when we talk to our US office, they're like, wow, your market's open. You actually took Amagi public. We understand that the pricing wasn't what it should have been, right? But hey, you took it public. That's big. And we've taken 8 companies public, got 7 more in the pipeline. And I'm saying that's a dream, right?
Yeah, no, you're spot on. I think one fact that gets lost in a lot of the narrative is even in 2025, while the net for FII selling was probably 20-25 billion down, foreigners still allocated about 7 or 8 billion to the primary markets, predominantly IPOs. So,
and look at, we again talking public markets. In the private markets, there is, as Amit said, 100 billion of capital. Right. There is a wall of foreign capital waiting to take bets. Yeah. We're not able to produce companies quickly enough to take that capital. So I just feel like it's a tale of 2 cities because, today there's a little bit of doom and gloom. I'm hoping next week it'll be better.
Yeah, I hope so too. How are you all looking at positioning your portfolios from an industry standpoint? Are you going, within the P band, kind of higher market cap, lower market cap, within the growth band and the venture band? Like, where do you see value today, both from an industry standpoint and then specifically market cap ranges? Again, maybe I'll start with you, Mr. Kejriwal.
I can't keep. This is Dhruv's way of shutting me down. No, I think you can't keep bottom fishing, right? So I think actually and again, I'll just say what our approach is, then be a broader perspective. Our approach is to actually see where we think we can add value. So even if it's, let me step back. The last 12 months, we haven't put the brakes, but we've dramatically slowed down deployment, given the valuation levels. So essentially, when you're deploying capital, your bar has just gotten higher. So we always think you're overpaying. You just got to make sure the degrees of freedom you had, if there were 3 or 4 in normal times, you have 1 or 2 degrees of freedom. So you've got to make sure your due diligence, you're completely safe on the stuff that you can be safe about, right? Governance, all that sort of stuff. Then you sort of say, what do you not know? And stay the hell away from that, right? If we would never touch something in real estate infrastructure, wherever there's a government regulation required, we wouldn't touch that because there are other players who can be a lot more competitive on that front than we can, right? So then we say, okay, even we have to overpay a little bit. Let's do it in a sector we understand really well, a theme that we understand really well, and then what is our value proposition or operating? So we used to have just an investment team. We have a much stronger, as strong an operating team. We have people like Nitin Paranjpe of Unilever who are actually working almost full-time with us to create change in the consumer companies that we acquire, or Keki Mistry who does that for us in financial services. So it's not just the investment. So you combine both those things, and even if you pay up a little bit, you do it only in the areas where you have 95% confidence and not 65% confidence. To make the change, make sure you get it, and try to find the stuff which is not being banker-led in terms of, so try to get it earlier. Having said that, as I said, we put not the brakes, but slowed down on deployment. We've really accelerated exits. And I think as Dhiren said, and we've taken 10 companies to IPO. We have only 28 companies in our portfolio, 10 to IPO. But now you also have a situation where sponsor-to-sponsor sales are usually prevalent. Naren and I have done a couple of companies we commonly hold, or I could have sold something, he could have sold something to me, and that's happening more and more. And given where India is in this little pivot away from China, even the strategic interest in India is increasing. So all 3 engines on exits are firing. So and again, I'd say I'll be happier to be lucky than smart. We just sold about a 500 million position in Vishal, Megamart, 3 weeks ago, and the world thought we were brilliant and we predicted the war. Obviously we didn't, but just keeping the discipline, returning capital is what's most important. So I think getting back to you, we continue just because AI is suddenly cool. I agree completely. We wouldn't jump into that. And there are much bigger players who are playing that field. So how do we play it? Just to be clear, firstly, across our portfolio, how are we enabling AI? That's far more important. But on our new investments, the only company we invested in, we put $300 million for 100% control in a company called Impetus, which most people, even I, hadn't heard of for 6 months before we invested in it. It doesn't do any fancy LLMs, but what it does is it organizes the data in an enterprise. So before any company, I'm no AI expert, these two are much better, but I'm saying before the company can start being AI enabled, you know how to play with the data, and that's the only thing this company does. So even if it's more services led, it won't be 100x, but if it's a 5x, we're thrilled, right? So again, from a risk reward permit, play in the areas we know, add a huge amount of values, and stay the hell away from the 90% of the economy which you don't know.
The older school, commoditized businesses. Interesting. Karthik, industries that you're excited about?
So, yeah, for us it's...
Tech is, of course.
Yeah. No, tech, of course, but also our job, strangely, at Venture is to bet on anything everything that no one else is betting on, right? We get paid to be ahead of the curve, so which is never easy. I think we've taken, we've always taken two angles to it, where we actually think tech, which is the origins of venture capital, true tech which can actually be differentiated and be sort of global quality, is something we want to still put 30, 40, 50% of the attention to. I think the government is taking note, launched this big fund. We've also applied for our share of it. We do think India has a right to win in that space. We're getting smarter and smarter tech talent coming out and wanting to build global companies. So we've, for example, in this avatar, we already have a outsourced product development shop on Bluetooth and Wi-Fi, which can replace all our sourcing requirements from China, right? And then we have a mental health sort of stimulation device, which is basically launching in the US. So these are things that typically no one would have heard of, and that's, as I said, our job. On India, I think we like how what got kicked off by Flipkart and then by quick commerce effectively has changed the way consumer adoption is enabling in terms of newer brands, quick commerce formats. Basically, we think retail can be rewritten in a very interesting way. So we have like a quick commerce play in a baby and childcare company. So the verticalization has already begun, so rapidly. So I think these are kind of trend lines that we're playing into, where we think the consumer base can grow out of just the premium segment into a mass segment. And globally, anything that we think on AI or on healthcare or medical devices, where we have a right to win globally. So these are early bets in Fund 5. So just giving you a flavor of it.
Very interesting. Naren?
I think our journey in India, and I've been doing this for 18 years, has been constantly sort of pivoting and changing. So our latest sort of pivot has been now focusing after many years of looking at it, window shopping. We've started doing deals in industrials and manufacturing. We really think that the current government is very serious. I think it is an imperative for this country to do very well in industrials and manufacturing. And therefore we want to we think we're already a little late, but now we have like 4 or 5 years of having seen many companies which we probably should have done, but that point did not have the gumption to do because we hadn't done enough, and now we're sort of doing that. So that's one sort of change. Our entire thesis is actually very simplistic. We are looking backwards. So we're basically looking at companies which will go IPO in 5 years. M&A has been smaller, more interesting lately, but I would say smaller. So, and then the idea is that we would like to make a 3 to 5x, but we certainly don't want to lose money. We come from a venture background, but we've sort of been more venture growth and early private equity. And so the whole growth equity, as you call it, I mean, I think we've gone, well, companies we've done after 2012, we have never lost money. That won't happen, but I mean, we want to continue to do that. So on one end, we're basically saying, let's not make sure we don't lose money. We at least make a 2x on that. We've never made less than that. And on the other end, in some companies, we've been able to make 25, 30x because they were venture, or even some private equity, we've been able to make, 10, 12x. So that's the sort of, now given that we're a global fund, I mean, we get comped against all the same US VC kind of metrics, and frankly, why would they allocate capital to us if we were not making more money than they were? And so that continues to be the struggle. We continue to deploy at an even pace. We continue to be sort of thoughtful. I always think that in India you have to overpay a little bit, but where that range is quite defined for us. So, and then we're very, very, I won't repeat that, but very detail oriented in terms of just spending time with our companies, and we have a full IPO playbook. So we'll really handhold and help them and spend time with them. So that's kind of our thesis. At the same time, we're sort of trying to also lean in a little bit more into the tech side. We think that deep tech could be interesting, so we're starting to wonder what we should be doing there. So it's a constant evolution in our, I mean, I think in India in general, but in our space in terms of what one should do, and so.
Super. I'm surprised none of you mentioned defense. I feel like the world that we're in, that's a theme, and I know multiples have been bid up there, so it's not cheap, but I feel like that's a world we're definitely heading into.
When I say industrials,
that's a big piece of it, of course. One last quick question. I know we're at time, so I'll keep it short. One wish that you would have for either our regulators or the government, in the spirit of being constructive, just so that we can actually take something back and say, hey, listen, this is a view that was articulated. Maybe I'll start and then you guys can go just to kind of break the ice on this. One thing that I wish our government looks at from a taxation perspective is FDI investors get taxed on capital gains taxes on their local currency, right? And so if they're US dollar investors, they get capital gains taxes on their dollar returns, whereas FPI investors get taxed on their INR returns, right? And in a world in which the rupee is depreciating as quickly as it is against the dollar, our effective capital gains tax rate becomes a lot higher. So my little wish is that we become, as FPI investors, on par with FDI investors and get taxed on our local currency returns. So like that, if there's any one or two things that, let's maybe go with one, just because we're at time and also because when you say one, then that kind of sticks. So Mr. Kejriwal, maybe you want to start?
Again, me.
Yeah, okay, maybe we can start this way then, Naren.
So I just feel that a lot more engagement with I think with the capital allocation community, because I have seen our fund in the US, I think there's a very special place because it creates massive jobs and it has a ripple effect on the economy. I think there is an acknowledgement of that from the government, but I don't feel that much proactive engagement like you'd see in other Asian geographies or the US. I think there is a will to do that, and so I actually think it's not that difficult to just go and say that, look, we want to talk to the top 50 funds and just understand the laundry list of things which are, and then we can go to a laundry, there are certain things where we've taken 13 months to get an approval. I think that's unacceptable. So those kind of things, then that's a laundry list, right? But just the fact that this is going to be, it drives jobs where all very patriotic Indians and want to do great. Is there a better engagement forum? And that's one of the reasons I'm here today, because I find that this is a great forum to engage. But is there a way to sort of engage more proactively? That would be very helpful.
Yeah, and I think that's a great suggestion, not just with the funds, but their LPs as well.
Absolutely.
The CalPERS and CPPIBs of the world, the big capital allocators. So that's a great one. Karthik?
I would love to see SEBI sort of re-rate what constitutes large cap, mid cap, small caps. I actually want almost every tech company to imagine that there can be a viable small cap listing. The bar keeps going higher, and now we're getting pushback from the market saying you're too small to get listed, you won't get coverage, small caps are capped out, they're not able to buy enough of you. It's just a shame. I think we should have purest tech small cap funds emerge by the dozens. If we really anticipate that is like a future sector that we're going to build for the next decade and a half, 2 decades. And we're just getting marginalized for no reason, whereas we should actually encourage more companies to go public sooner, in my view.
Yeah, no, that's a great one.
So listen, one serious, one little bit more in jest, but the serious one is similar to yours, tax related, but it's just stop harassing taxpayers as investors as taxpayers, not the stuff that you talked about, that's sort of the second or third derivative, but just all of us doesn't come back here. I do believe we need to live here, to invest locally. Everything we do is 100% clean, but if you're getting a tax notice after every divestiture you have, it gets really annoying. So that cumulative stuff, and it's not just us. And then again, Tiger, it is what it is, but you can't have the repercussion of that as ammunition to an officer to say, hey, Naren just bought a really fancy house and car, let's go and, let's look at it. He did. But the little bit of one in jest is, I do think this government has done an excellent job. And that's, the growth, if you look at Mumbai, it's with the, all the stuff going on, infra and otherwise. So let's just make sure PM, Home, and Commerce Minister stay on forever. And Dhruv may have a little bit more acts than the rest of us do to pass that message back to the government.
Very kind of you, and thank you all for coming onto this panel. Really enjoyed it and very grateful for your time. Thank you. Thank you.
How are you? Good to see you, Sharon. Yeah. We're the next one. Yeah. Right, let's get it on. I'm going to invite our next two panelists to the stage. Nicholas Blank, Managing Director, Nardello & Co., and Babita Ambekar, Partner and Head of India Desk at CMS. Please make your way to the stage. Otherwise, it'll just be me. You would not want that, Babita. Nicholas, good to see you. We've got about 10 minutes, I think. Yeah. So we're going to rattle through it. Same question for both of you, just to get things going. When serious capital, international capital, is considering India right now, and you're the people they come to, you're the people they ask this question to, what is the question? What's the single biggest question they're asking when they're looking at India from a capital allocation perspective? Babita.
Okay, well...
And then you can answer it.
So I think that, from my perspective,
yeah.
The sentiment for investment in India is really strong. The interest is very strong at the moment. People are very keen to get involved in the Indian market. So there's a really, really strong buzz there. But I think a question that people are asking is, how can I participate in this brilliant, fantastic market whilst looking after my investors' interests and making sure I manage things on the home front?
And in a sentence, how do you answer that?
It can't be answered in a sentence.
You can obviously have more than a sentence. Yeah.
No, I think you need to strike a balance, right? So you need to find a way to operate commercially and with a local mindset. I think we talked about local mindset slightly earlier. A number of the multinationals that I work with have realized, and it's become apparent to them, that they need to be very local in the way that they think. Their international perspective is not going to just be reformulated here. But what they are doing is they're making sure that they do it in a way that makes sense for them from a tax and investment and other perspective.
Nicholas, what's the question?
I'll be brief. I think most foreign investors ask really one or two questions. They're interested, number one, in whether their investment target is litigious. Are they going to invest in a company that has a long track record of disputes and litigation with their investors? Number two, if they come from a highly regulated jurisdiction like the United States or the UK, they're concerned that their investment might backfire on them due to corruption risk in the emerging economy like India, in the sense that they make an investment, their investment has now touched upon a very corrupt issue, and now they are potentially subject to fines in their home jurisdiction.
And your job is to look beneath the story, Nicholas. I mean, when you're investigating, when you do the due diligence in a company, in a sector, in a deal, what are the gaps that you see for what India says about itself and what you actually find? What's that gap look like?
I think one of the great things about India is the free press. In a lot of other jurisdictions, it's difficult to gather information. So you have a situation where you have to go out and ask humans, you have to go out and ask sources a lot of questions. In India, there's almost too much information. So you're actually able to gather a mosaic, a portrait of the entire picture. So I think it's not so much a gap, it's actually being overwhelmed with information and having to conduct very good analysis to put the pieces together and understand what the true risks are.
Babita, what about from a legal and regulatory standpoint? What do you see when investors try to get deals done in India? What does the framework look like? Where does the framework work well? And maybe where does it create friction?
Okay, I think that there are often different expectations about what will transpire when we investors enter into a relationship with an Indian party, and I think that where I see it work is where that is acknowledged at the start, and people establish a framework where they're going to be able to manage, perspectives internationally, but operate locally. Where I see that work not so well is where people have just ventured into something and not really thought about it. And then they often come to us, of course, to, deal with it, unwind it, or, unfortunately.
Yeah. Nicholas, when your clients are weighing up India versus other markets, I mean, you deal with other markets as well, where do you find its institutional credibility actually sits versus other markets? Does it sit well? Would you say institutionally its credibility is improving fast enough?
I think, India's institutional credibility has always been very strong. I think one of the issues with capital is how quickly information can be accessed. So there are some institutions, for example, the Ministry of Corporate Affairs, MCA. It has robust amounts of information. You can probably get more information on a private Indian company than you could on a US company. The issue, however, is the database is always broken. So that's the question of speed. Investors don't want to sit and wait for weeks and weeks while someone retrieves corporate records.
Yeah, Babis, I think this morning you took part in a roundtable, didn't you? Taking Indian companies' global risks, rules, and realities, and you were looking at the impact of the India-EU FTA, which of course has recently taken place. Do you, as a result of that, do you expect a pickup in Indian corporates, Indian family offices using Europe as a base for acquisitions, for listing, or for treasury operations?
Yes, basically.
Yeah.
We released a preliminary article on the EU-India FTA. We're releasing a series of those, but the first article received a very massive number of views. So I think that there is a lot of interest. We have clients asking what is this going to mean for them. At the moment, it's, we're in the early stages. So we're still iterating as to what this is going to mean from a material perspective, but I think it will clearly mean more opportunities and more tangible, initiatives taking place.
Yeah, I agree. In terms of acquisition, I think it's definitely going to make it easier for Indian companies to go overseas and acquire foreign companies. I think the historic offshore centers where family offices, private equity, various investors can be positioned, Dubai, Hong Kong, Singapore, very low tax rates. I don't think Europe, maybe with the exception of Jersey, will necessarily replace those offshore jurisdictions for being a seat where the sort of family office is located. But certainly in terms of capital flows, absolutely, there's going to be many opportunities for Indian companies to invest abroad.
Babis, I want to come to tariffs, big theme, of course, as we all know. It's been just touched on briefly here. How do you advise your clients to future-proof against tariffs, trade issues, which of course are becoming such a big part of doing business now globally, and it's always up in the air? They're becoming more of an instrument politically. How do you advise your clients to future-proof in this difficult trading environment?
So firstly, commercially, and I think this applies not only to companies that are operating in this channel, but companies globally, we are recommending to businesses that they effectively decentralize. They need to hedge against any one market. So any business that is overtly focused or dependent on a single jurisdiction, we are encouraging them or requesting to them that they consider applying a strategy which diversifies their bases, their risk, and their reach. The second thing from a legal perspective is that we're asking businesses to look very carefully at those sort of provisions, the force majeure clauses, any hardship provisions, maybe purchase price adjustments in view of, these type of changes, because I think that it's very unpredictable at the moment what is going on in the world. And I think the key from a legal perspective is to remain agile and flexible and to reflect that in documents.
Agile, flexibility, very important. 30 seconds. Sorry, Nicholas, go on.
Yeah, I completely concur with that. And I would just point to the example of China, that since the tariffs have been implemented, China's exports to the world have actually increased.
Yeah.
So, and it's very much because they targeted other markets aside from the U.S. To export their products. So it's absolutely about identifying new and different markets.
Looking to 2030, our big capital outlook for 2030, 30 seconds each. Babita, you first. What does India need to do to ensure it remains front and center when it comes to capital, being the center of capital, promoting, allocating, attracting capital? What would you like to see?
I think India has got a good story right now. So I think there's a lot of interest with respect to India. So it's a question of channeling it. We need to make sure that India channels this in a really proactive way. We've spoken about this before, but making sure that there are not overt hurdles, making sure that investor confidence remains high. These remain key.
Yeah, Nicholas.
I will answer a question by asking a question, which is, what happens after Modi?
Right.
So India is a country that has developed very quickly in terms of the coastal cities, the coastal areas. If you look at the FDI into India, I think one of the gentlemen before mentioned something like 50 billion. Most of that has gone into the coastal areas. A very tiny percentage has gone into the interior. Same thing happened with China. But if you look at the China example, people in central China can't vote. People in central India can vote. So I return to my question, what is going to happen after Modi? Will it be the same environment, regulatory reform that attracts capital to position it well in 2030 or not? I don't know.
What happens after Modi? We'll leave that there, just hanging in the air. Thank you both. Babita, Nicholas, big round of applause. Thank you. Thank you. Well, we'll do a photo. Thank you very much. Thank you. Yeah. Okay. Thank you very much. Great. Right, Bankers Boardroom. Are you ready for our Bankers Boardroom? Let's get Manisha up here. Manisha, where are you? Manisha Girotra, CEO of Merlis. Let's give her a big round of applause. Umang Papanager, Managing Director, CEO of Julius Baer. Let's put you in order. Boom, boom, boom. And then finally, last but not least, Sharad Agarwal. Hi, Sharad. CEO India Emirates NBD. Hi. Good to see you all. Wow. There's a lot going on in this world, especially for banks out there. Tough environment. Money costs more. Regulations tighter. The rules around credit flows are shifting. But India has real momentum, we'll have to agree. But it's not operating in a vacuum, as we know. This session is all about how India's financial institutions are building for that reality and what it means for how growth gets funded. Sharad, Dubai, We've got to start with this. It'd be remiss of me not to start with Dubai. Emirates NBD is headquartered in Dubai. It's been a crazy, crazy 10 days, I'm sure, for you, for your colleagues, for everyone you know in Dubai, and I'm sure for all of you, your families and friends who are in not only the UAE, but in all those countries in the Middle East that have had missiles flying into them and drones. It's been absolutely incredible. Given that Dubai is so important for you, it's so important for India, and given that the India Gulf Capital Corridor is one of the most important bilateral financial relationships in the world, is it resilient enough, Sharad, to survive what's happening now? Would you say this crisis accelerates or slows the deepening of that very great relationship between the UAE and India?
So people in Dubai who has always thought that this is the safest country in the world, and which has always been the case also. And now for last 10 days while having dinner, they can see missiles being fired from here and there, and sounds and sirens. Never before the SMS has beeped so much on their mobile, because Dubai has an alert system where they alert the citizens whether to go out or not. So things has been pretty crazy, yes, for last 10 days. But honestly speaking, when I speak to my colleagues in the head office, they say that life is as what it was 10 days before.
Okay.
In fact, it was about Monday when it was told that you all have to work from home, but after that, they all are working from office nowadays. There has been no travel restrictions. There has internally, within the Emirates also, there has been no restrictions on people going out. So things are pretty much easy. Yes, there has been tension in the Middle East. There is no doubt about it. The country has provided enough security and assurances to the residents of the UAE, like the other Gulf countries also. Yes, there has been a crisis overall. Till when the war will last, what will be the scenario? There has been no oil flows which are happening, and most of the countries, as we read today, have stopped their oil production because there is no shipments happening, and they all have a limited supply storage capacities. And in fact, in Fujairah, there has been 1 or 2 hits also on the oil supply, on the oil storage. So far, the economies are fine.
Yeah.
How long the war will go, that all depends in the coming days to see. There has been talks about the de-escalation, which even the president of US has mentioned about it, but it's very uncertain. Yes, in terms of the business relationship between the two countries, there has been no doubt that it's at the highest levels of coordination and cooperation between UAE and India, whether politically or economically. The CEPA has led to massive increase in the volumes of trade from what it used to be, and the numbers has been revised for 2032 to $200 billion. So that means the confidence which the UAE and India feel in increasing the trade between the two countries. Strategic discussions, security level discussions, food cooperations, food parks, what you can't think has been happening in last 7-8 years between the two countries. Coming back to India, in terms of the resiliency of the systems, I think there has been no better times for the financial industry in India than the past. If you talk about capital adequacies, banks are running at about 14.7 capital adequacy against 11.5. The NPL levels, both at the corporate and the banks, are at the historical low level. RBI, yeah, they may be a strict regulator, but I still feel they are the best in terms of their supervision, their stress testing, their control over the banks. So things are very, very positive from the perspective of resiliency of our system. We have been talking about stress testing. RBI has now introduced expected credit loss framework in the banks from the earlier incurred loss basis. That's another system which they are introducing. So I think financial systems are pretty smooth.
Yeah, good. That's what we want to hear. So far, so good, 10 days into this conflict. Umang, your clients are some of the wealthiest individuals in India, wealthiest families. How are they reading the last 10 days or so? How are they putting their money to work? Are they sitting on the sidelines? Are they quietly shifting their money? I know it's early days and no one makes sudden decisions because that's the worst type of decision. But what's the feeling you're getting from your clients?
No, so far we've not seen any drastic change on strategic allocation. So just to take a step back, most clients actually divide into three parts. So first, of course, is the safety pot. Then we have a growth pot, and the third is what they keep for future businesses. I don't think that strategically thinking changes at all. Safety pot remains safe, and I'm sure they've seen much more volatile times than this for them to go and make a strategic allocation change that quickly. So, and most of it is home bias, because there are certain restrictions that we cannot really send out money freely. And India was a market all of us know that underperformed last year. So it's not even crashed like the way other markets have. So I think people are just staying put.
Yeah. Manish, what about you? Because you advise on deals where international capital, of course, comes to India. And over the last, let's say, 18 months, give us a sense of the appetite of big global banks and institutions to put serious money into India. Is it growing? Are they being more selective about the sectors, the companies they're investing in? Give me a sense of where we are, and give us a little flavor about the last few weeks as well, how it fits into that.
Sure. I think if you see in the last year, M&A in India was about circa $100 billion. $40 billion of that was private equity capital coming into India. There's Sanjay and I are there who really started the whole private equity investing into India. And then about $40 billion of cross-border and domestic M&A. So I think what remains a real continuous pool of capital is private equity, and what changed in the last 12 to 18 months is that private equity saw real exits through the public markets. Earlier we had to go, if a deal size was above, let's say, $700 million to $1 billion, one had to go looking for that strategic from the US or Europe to come in and buy the company out. No longer the case. Large companies such as Coforge, Hexaware, etc. Basically, private equity went and monetized their stakes through the public market. So that was a big change and encouraged private equity to put more capital into India. Strategically, I think India's done well. I think, what you said in your first question, India's done very well in accessing different pools of capital. So we've tapped the Middle East very well. China was sort of a hiccup, but today, again, we saw that we opened our markets to China, investing again. Press Note 3 has been lifted. So we've done well in getting pools of capital from Singapore. Singapore's been a large, Temasek, GIC have been a large investor in our country. So we've done that smartly. We've de-risked ourselves. And I think the other big thing that's happened in India is that we've been able to channelize domestic pools of capital into the formal economy. Demonetization happened, we created the whole Aadhaar infrastructure, and the kind of flows we are seeing in the public markets from domestic flows has been unprecedented. And that's really what held up our market last year. We had a record IPO market. In December, we did 23 IPOs. December markets world over are shut, but we managed to do 23 IPOs worth about $3.7 billion. So I think the fact that we now have different pools of capital for a country of our size has been a real positive. Private equity, global strategics, domestic pools of capital, they've all come together, and hence we are seeing a good, robust flow of M&A. Last 2-3 weeks, as you rightly said, nobody makes decisions for 10 days. I think our deal flows that we are talking about to private equity and other investors, we continue to talk about them. Some of this will get priced into valuations, I suspect, globally. As was mentioned earlier, India has corrected a lot last year. It was looking very rich 18 months ago, but I suspect some of this will get valued into pricing as investors get more cautious on the world if the war continues.
Yeah, let's see. Sharon, I want to come back to the relationship between the UAE and India. It's an extraordinary cross-border relationship. As NRI wealth grows, as bilateral trade deepens, these things are happening. Talk to me about the infrastructure. Is the infrastructure in place? Is the right infrastructure in place? Is it moving money as efficiently as it could, should, and will? What would you change? What needs to change?
See, it's very easy to move money from UAE to India, obviously. It's a bit tough to move money from India to UAE, which is obviously because government doesn't want capital outflow as well in terms of the huge expenses. But yes, if you talk about, like I'll just give you an example that the NRI money which used to come from UAE or the Gulf countries to India, there used to be money exchange market, and all the market which was through the remittances was controlled by the money exchangers. Few years back, we started a product called Direct Remit, and which means that we tied up with few banks where your money will be transferred to those banks in less than a minute. So whatever amount which you want to transfer from there. And the same product we replicated between Emirates NBD to Emirates NBD. So from the Gulf countries, in less than 10 seconds or 15 seconds, your money is transferred from UAE to India.
Yeah.
The other way, yes, obviously we are controlled by the LRS flows for the individuals, but I think government is very flexible in terms of the capital flows when it's an ODI or in terms of other foreign investments which you want to make to the Gulf countries. It's pretty simple. And the banking is pretty open, and obviously after the grey list of FTA also, the UAE has been very, very cognizant in terms of the rules and regulations and has imposed a lot of restrictions on the KYC as well. So it might be tough to open an account, but it's good to have an account in due course of time, provided all the compliance checks are done. In terms of banking, I found it very easy and convenient these days because we see a lot of flows happening, vice versa. And in fact, 3 of the banks from Middle East has been increasing capital, whether it is Mashreq, Fab, and we are talking about almost 3 billion of capital investment in just months to come when we talk about RBL.
Yeah. Mang, I want to talk about alternates, as they know, because I know that there's a real appetite among wealthy and Indian investors to move away from bank deposits and into mutual funds, alternatives, and this is happening at quite big speed at the moment. What's driving that right now? Is it sophistication? Is it search for better returns? Is it the fact that the rules are pushing wealthy families towards alternates right now? And would you say that the products are keeping pace with the appetite that's out there right now?
True. So again, let's take a step back and try and understand how conventional investing used to be. So it largely, if you go probably a generation up or maybe 2, largely it was real estate and gold. Now when you look at the whole savings pool, so India has a savings pool of around $15 trillion, out of which only $5 trillion are in financial assets. The rest is gold, real estate and fixed deposits. But incrementally, as we save say 17-18% of GDP, incrementally most of the savings happen in financial markets and not in, so there's a lot of, probably because of the next gen coming in, they do not want to really block into real estate assets or fixed deposits which are no longer very tax efficient as compared to other instruments. The other thing what we're seeing, as you said about products, so products are keeping pace. So there was a regulation which came out in 2012-13 called the AIF regulations. That was alternate investment funds. Now in 12 years we are at $100 billion of committed capital. So 100 billion in just about a decade. Obviously you're seeing what kind of pace we are keeping in terms of product innovation. And mutual funds of course have gone to a different level, more like 800 billion or so. So as more and more financialization happens, I think if that skew, which is 5/15, starts to change from 33% to something higher. So probably, did I answer the question?
Yeah, very good. Thank you so much. Manish, I want to just touch on...
to add upon one point.
Yeah, please.
While he's happy that deposits are moving, we are not happy at all.
Yeah.
Banks are facing a serious crunch of CASA deposits and low-cost deposits, particularly the retail deposits in India. And that's going to be a serious, serious concern. If we talk about our GDP of, say, 5 trillion, and if we are increasing to 20 trillion over a period of time, the availability of liabilities to the Indian banking sector is a serious concern. Yes, all of us wants to be high on the returns, and even we also keep low deposits in the bank. But ultimately, banks need this raw material to produce.
Yeah, I want to move on to non-bank lending, Manish, if I may, because private credit right now is a massive theme. If you pick up the financial press, especially specific funds which are not allowing clients to pull money. So we're seeing non-bank lenders step in where traditional banks are pulling back. What's the private credit space like in India? Is it shielded from all this private credit naysaying that's going on in the Western world? And is private credit, is it a healthy evolution of the financial system, or would you say it's a risk specifically in India that isn't properly being considered?
I think it's very early days. When it comes to financing for M&As, it was basically restricted to global banks and financial sponsors earlier. Now Indian banks are allowed. It just happened, so we'll see Indian banks also participate. But private credit's been a new entrant into India in the last 12, 18 months. There were a couple of firms like KKR, etc., which did it earlier. But basically now, if you look at every firm, whether it's an Apollo or Warburg, they're all talking, Blackstone, they're all talking about how they want to push that product in India, given globally the problems it's been through. So I think they'll do well because they provide a lot of flexibility on the cap table, and our Indian promoters want that, right? Not everyone wants dilution, or not everyone wants too much leverage, and I think they provide that flexibility as India gets more and more hungry and wants to do more global acquisitions, or just expand organically. So that the early discussions that we're having, there's a company called Jubilant which bought a large Coca-Cola bottling company last year. It was mostly funded through private credit. So you're seeing a lot of that activity happening. I think that there's a lot of competition now, especially with domestic banks also being allowed to lend. But as was mentioned earlier, the domestic banks will continue to be heavily regulated by RBI, right? RBI has been very good and vigilant about monitoring. So let's see how they're able to actually fund these founders. I think all these pools will coexist. So you'll see private equity doing well in India. Will it just go like it went in the US? I don't think so. No. I don't think you can see that trajectory. But I from the conversations that I have with all our clients, they're very, very intrigued at this point.
Yeah. Let's look at 2030, the capital outlook. That's what this conference is all about. Sharad, we've talked about the relationship between India and those Gulf countries. We've talked about the very important nature of the bilateral relationship. What does that relationship look like in 2030? What more do we need to see to ensure that that relationship is thriving and firing on all cylinders?
I think as we grow in terms of the GDP, we need more banking partners in India. We need more capitalized banks, which are pretty heavy in terms of lifting the growth ambitions of India, in terms of the capacity expansion and the capex plans which we are having. Today, when we talk about a 20-25-year loan, it's a bit difficult to get it in India from the normal banking channels because there is pressures on LCR, there is pressure on NSFR. The liability match there is a serious mismatch between the liabilities and the asset profile. So definitely the alternate financing is one of the options, and RBI has been very relaxing in terms of going for NCDs or other private source of financing for these kind of assets, and companies have opted for that also. But I think it has not taken up the way RBI was looking for, and they actually withdrawn that circular where they capped the bank finance for large corporates. So we definitely need other methods of financing, whether it is private equity, whether it is non-convertible debentures, or any other methods. In terms of, since current account deficit of India is always negative, we need the external financing. So ECBs continues to be a large source of investments for the banks the companies which are going into capital expansion. The relationship which we have, particularly from the Middle East countries, I think there will be large capital inflow which will keep on happening. But still, if you look at the number which even UAE has committed in the past, from $100 billion they came to about $50 billion, but that number has not been achieved. So I think there is enough which needs to be done by the government on both sides, where those committed capital investments also should fructify.
Yeah, 2030, Umang, India's creating a lot of millionaires and at a pretty quick pace, quickest in the world. By 2030, where's that money going, Umang? Is it being put to work productively in India, or does it need to go overseas, elsewhere?
So as of now, we've not seen too much of overseas diversification. But I'll tell you what's happened over the last few years, and starting from the circular of August 22, which the Reserve Bank came out. So now there are largely three buckets if, say, a family wants to set up a family office abroad. So first thing, of course, is Gift City, which is the own Indian solution, or area similar to like what DIFC is in Dubai, for instance. So if you are a corporate in India, you're a LLP in India, or you are a partnership, you can send out 50% of the net worth of that corporate LLP or partnership to Gift City products. So that changes your addressable market considerably if you're sitting in my position, because earlier we were only looking at $250,000 per person per year, and this completely changes. So if I go to a corporate with say 500 crores of net worth, you're basically sending out 250 out, right? So that's point number one. Point number two, RBI also came out with NBFC subsidiaries in Singapore or ADGM or DIFC. So a lot of work is happening. A lot of colleagues from the Department of Economy and Tourism from UAE come and talk about their offerings. So I see that also taking off in setting up family offices abroad. Now, circa 2030, I think it will be a combination. So far we've seen less than $1 billion going to GIFT City. And every year when you see that large number of LRS limits, I think less than $1 billion goes out every year for investments. Most of it goes for education. Now that I think will considerably change going forward for families wanting to invest abroad. And it will be a mix, as I said, of always the home bias will remain because India still remains a growth market. But there will be a new element in allocation portfolios, which is a global angle, which does not exist today.
Manish, well, let's finish with you. Final words. You've advised on some of the biggest cross-border deals in Indian history. What sort of transactions are we looking at in 2030? What are the types of deals do you think will be taking place? Are there any bottlenecks that are preventing those sorts of deals?
Sure. I think what's been a heartening change has been that domestic capital is now ready to get deployed into India. So you're seeing domestic strategic players competing with international players and winning on assets. That never happened because if you went into an Indian entrepreneur and had a build versus buy conversation, you were thrown out of the room because it was like, come on, I can build this at 7 times EBITDA. Why would I go and pay 24 times EBITDA? But now I think with the size of the economy galloping so fast, and if you want to remain a large, meaningful player, you need to think inorganically. So the fact that today you're able to get domestic pools of capital become credible allies and actually competitors to international pools of capital is a very healthy outcome for a country of our size. We can't just keep relying on international pools of capital. So whether it's the public markets, whether it's the domestic pools of capital, I see them putting more and more money into India. Unlike earlier where it was like the market size was so small, so if you were a Bharati and you wanted to grow, you had to go and buy something in Africa, right? That's not the case. So I think come 2030, I see more domestic pools of capital and domestic strategic players playing an effective role. Private equity continues to see this as a safe haven. I think all that we need to do is to make sure that we ensure that there's geopolitical stability, rule of law, our states continue to compete with each other and attract foreign capital, and of course, currency stability if we can.
Well said. Let's give them a big round of applause. Thank you so much to Sharad Umang and Manisha. Thank you very much. Let's get some photos. Thank you very much. We're doing the GIFT City. The next one. Right, policy playbook. Sanjay Nair. Sanjay, get up here. Founder of Soren Investments. He's just popped out. And Santanu Sengupta, Chief India Economist at Goldman Sachs. You can come and join us. And Sanjay has just stepped out. He's coming in, is he? All right, we'll give him 1 second, and then we'll begin. Get my notes ready for all my stuff. Here we go. Here we go. Come and join us, Sanjay. Yeah? They're all coming in a few minutes, are they? Should we start? Are we starting? Yeah, come and sit here. Come and sit here. Yeah. You want to wait for a couple of minutes? We okay, Artie, to wait for a few minutes? Yeah, let's wait a few minutes. Yeah. We'll give it a minute. Everyone meditate for 1 minute before we talk policy. Yeah. I don't know actually. Yeah. Yeah. Oh, you can be frank. Please be frank. Yeah. Yeah, sort of broad policy. Yeah, exactly. Your macro, yeah. Yeah, I know. Okay. I'm good, yeah, it's been a while. Get in, yeah, at midnight. Yeah. Going back tomorrow, yeah. How's life? Did you? You got in? So flights up just 4 a day. That's pretty good, isn't it? Right. Is it safe? I mean, are the planes escorted by the Air Force or what? There's some corridors that you don't see. Doesn't happen in India. Yeah. You want to start? Okay. We've been told to start. Start we shall. Okay, great. Sanjay's here, Santanu's here. It's our policy playbook. Policy. Santanu, we had India's own economic survey, didn't we, lately, which made an interesting observation, I thought, that India's strongest economic performance in decades, it's collided with this global system that no longer awards good economic management with stable currencies, capital inflows, or strategic protection. So from your standpoint, from Goldman's standpoint, is that diagnosis right, the economic survey? And if it is, would you say this is temporary turbulence, or is it a permanent change in how the world prices emerging markets?
Yeah, thanks. I think there are two things happening here, right? One is that you're going through a changed global order now.
Yeah.
But macro stability still is the bedrock of garnering flows. What's happened in the last couple of years is also slightly different because, I think there's a cyclical element to it apart from, whatever is structural going on in the world. You still went through an economic downturn, partly the RBI clamping down on unsecured lending, partly very, very much fiscal tightening, almost 1.6 points of GDP in the preceding couple of years from 2024. You get into this economic downturn, your earnings go through the downturn, you have a bunch of capital outflows, and then in this year, you have the AI wave going on where India is being found on the other side of the wave. The hardware guys are Korea, Taiwan, the software guys are US, partly China, and India is sort of still trying to find its position in this AI world. So I think it's just coinciding with a bunch of cyclical as well as structural headwinds. But it will be wrong to say that macro stability doesn't get rewarded because when the tide turns and if your macro is unstable, it'll be difficult to get flows back. One last point, since I have the mic on macros, is that eventually, if you look at your FX move, you were quite expensive in the beginning of last year. if you look at it from a sort of trade-weighted, inflation-adjusted terms with all your trading partners. And therefore, some adjustment was possibly due. And it's just that it coincided with the time when you had the outflows, and therefore the RBI sort of let it adjust far lower. So I would say that valuation-wise, at least, the other assets aside, FX-wise, valuation-wise, you've adjusted to a more reasonable level.
Sanjay, you've deployed capitals across multiple cycles, multiple global regimes. How does this regime feel? Does it feel different to you? You've seen many different versions of this. Where are we now?
No, I think, to Shantanu's point, I think India, from a macro perspective, is in a pretty good shape. But I'll quickly add the but to it. That's all good. But the fact is, it's at a much lower growth rate than what the potential of India is. So, if you're talking of capital and what brings capital to a country like India, besides other things, is that you end up underwriting growth, okay? And I think you need to see growth. And I'm sure you're going to have more questions around growth, but from my perspective, we have some structural issues that we cannot change overnight. We're energy dependent. We have dual deficits, but we manage them pretty well. But, it's like settling down. What do we learn in school? LCM? Lowest common multiple. So 6% growth, 7% growth, nominal growth of 9 to 10%, that's pretty low from all perspectives. Now compared to the world, this is great. So to his point, on relative basis, macro solid, relatively macro solid, maybe valuations are getting back, but we need growth. If to attract capital, you need growth. Nobody's coming to India for being in safe haven or Switzerland.
So
okay?
we need growth.
They come here for growth.
Okay, so we need growth. So how do we get growth?
So I think so as I said, leave the structural issues aside. We can't tackle them overnight. I think even if we were just discussing, if the capital output ratio is 4 and you want to grow even at 7 to 8% real growth, you need 30 to 32% savings, okay? And I think we're at 21, 22, probably one of the lowest numbers that I have seen in about 2 decades. And maybe that's because the household debt is going up or whatever it is. But the fact is you don't have enough S minus I, what do we call it? In economics, what do you guys call it? But according to me, there's a big savings deficit to finance growth. And the only solution has been that the government has been cutting checks from its own balance sheet. They have bankrolled infrastructure. They bankrolled us post-COVID. They've, in a way, bankrolled by cutting corporate taxation to 25. They've cut GST. I think they've done a lot from their side. But the private sector, who's highly deleveraged right now, is not responding. So how are you going to get
why aren't they responding?
Well, that's a question we should talk about, definitely.
Yeah.
But so if the private sector is not going to respond, and after years and decades of protection, now there's a bit of someone poking a needle in their dress and everybody's screaming. The fact is we've been protected for too long, and the private sector, I don't think, has done enough to enhance scale, quality, AI, whatever else, right? And now we're suddenly feeling like we're left behind. So I think we are at a growth crossroads. I think the government has done a lot, and you can't expect them to keep doing it. So the private sector needs to step in. So maybe I'll stop there.
Let's come on to the private sector, because the finance minister said that Indian companies are sitting on money rather than investing it in new capacity. She called it passive investable funds. How do we get this money being spent?
Yeah, I mean, the leverage, one way of looking at it is that balance sheets are super strong. But balance sheets are strong for a while now, both for banks as well as private corporates. And there's this element of wait and watch going on for quite a bit of time now, post-pandemic. I think the most recent was the US-India trade-related uncertainty. It clearly had an impact in terms of corporates thinking about investment. But I would totally agree with Sanjay that unless the private sector really comes in and drives the investment cycle, it is very difficult for the government to drive any further because of the fiscal constraints. I mean, while balance sheets are excellent on the bank side and the private sector side, the government balance sheet is quite constrained. I mean, India runs one of the highest public sector debt to GDP amongst EMs, and the bond markets are giving you a pass because you can deliver 10% plus nominal growth, right? So that's the reason why you get the pass with 80% plus public sector debt to GDP. So yeah, I mean, I would agree that the private sector needs to come back in. With regards to savings, I'll just make a quick point. Our view is that this is probably the retirement savings or pension moment going on in India. You have about 5% of GDP within this savings pool, financial savings pool, getting allocated towards these long-term savings, namely pension and insurance. Pension is getting formalized in India, and there is no way of accessing that money towards infrastructure creation right now, because that is more or less anchored to the sovereign balance sheet, or it is now moving into a little bit of equities, but that's mainly index equities or large cap equities. But if you can think of a structure where the pension fund manager, who's looking for long-term assets because his liabilities are long-term in nature, is able to access paper in some way, and I'm not saying only debt, it could be hybrid, it could be different structures, which can create infrastructure. That's the way to take this forward, rather than...
I think the original point why the private sector is not investing, it really, even I'm pretty confused about it. I have lots of friends in the private sector, but
what do they say to you?
I think one is, of course, the broadest word we use is doing business in India is not easy. Okay, so that's one part of it. And
quick poll, put your hands up if you agree with that sentence. Doing business in India is not easy.
Okay, so anyway.
There's not that many. Okay, put your hand up if you think it is easy.
They've got to first have they've got to have a factory and then they see what they say. But anyway, but I think one is, so I think that's an overused word, but the guys who could get it done, they'll still get it done. But I see the same feedback from the foreign direct investors, not private equity, but the guys who want to come in here and, like a Schneider or whatever. It's tough, okay? But I think the government is trying a lot to make it easy for them. I think the second issue is what the previous panel said. There is a certain psychological change in this country. Families are cashing out, promoters are cashing out, they're creating these ODI structures to, what did he say, Dubai, ADGM. So there's more outward investment than in your own country. I think in the 60s and 70s, the big old houses, the Dalmias, the Singhanias, the Tatas, I mean, they used to borrow money and put up projects, okay? You reinvest in your business. I don't see too many of the reinvestment opportunities. And private equity is different, okay? To Manisha's point, private equity comes in, they're interlopers, they come in the middle, they get some growth, some improvement, and they sell back to the capital markets. That's not necessarily asset creation, okay? They're just buying assets, making them better, and selling it. So who's creating assets, and therefore where does the growth come from? Actually, I'm totally confused. Maybe somebody in the audience knows as to why the private sector is not enthusiastically reinvesting in the businesses, expanding capacity.
Why isn't the private sector enthusiastically reinvesting?
I'll just
Answer
add
first.
one last point on this. There is an element of, if you look at China across different segments of industry, especially new industry, not so much old, the competitiveness is at another level, both in terms of the amount of industry share, market share they're dominating, and the price competitiveness that they have. Exchange rate depreciation is just taking away part of it, but it cannot cover up for the amount of competitiveness that some of these new industries, China has already entrenched in.
Yeah.
So I don't know, anybody has an answer?
The answer is, what's going to unlock the private capital that's sitting on the sidelines? Come on, someone, have a go. Yes, sir, give him a mic. What's going to unlock it? Because we don't have the answer. Policy certainty.
If one thing that private capital absolutely hates is uncertainty regarding policy framework.
Well, given that this chat's called Policy Playbook, what policies do you want? One policy that you'd like to have announced by the government, which maybe would help move that capital?
Maybe stand by the previous policies which were announced.
Is that fair? Stand by the previous policies that are announced.
Tax holidays, land acquisitions, federal or state level resource allocations. Just stand by what was announced in the past. I think that's more than sufficient for our country.
Fair?
We have a reasonably good enterprising people, entrepreneurs available, and good amount of now capital is, I believe, is not as big a constraint as it used to be 20 years back. So policy certainty.
Yeah, I think the fact has been recognized by the government. You know, they have now a ease of doing business committee headed by the CAB secretary. So I think things will happen, but you know, the committee is composed of all bureaucrats. So it's not your Doge moment for sure, but definitely there will be attempts, and I think they're making a lot of progress between states and the center to clarify rules. Like it will take time. So I think we have missed out a couple of decades of this thing that we should have really been more manufacturing friendly. You know, e-com and services not going to create your employment, okay? It's got to come from manufacturing. So to your original point, actually I'm a bit lost as to where we go from here, because for me, I see this as an LCM model for India, but yeah, very safe in today's context, right? So I really don't know how to unlock growth here. I'm really confused.
Yeah.
And therefore private capital...
Luckily you've got an economist next to you.
I know, so private equity will come in, they'll look for relative value, some cheap valuation, do some structured deals, and then, you know, get out. But the fact is, promoters are selling, founders are selling, and they're taking money out of the country. And that is bewildering, yeah?
Completely hear the audience uncertainty, policy certainty, absolutely important. I think Sanjay mentioned an important point, which was the cabinet secretary heading the committee which is looking at state level reforms. Now these are tiny, these do not make headlines, but super important in terms of sort of ease of doing business. The problem is that once you get that changed, the execution of rule of law quickly is very important, which is, you know, then you go back to like judicial capacity and so forth. So the bunch of things to be done for that execution to happen really on a sustained basis.
Yeah.
You know, I have one very controversial comment to make, okay? I also think Indian founders, promoters are getting so focused on their valuations. Okay, we should be investing in AI, and we all know our R&D spend is pathetic, okay? Now AI is staring in the face. No tech company wants to be able to deploy billions of capital in AI because return on capital will come when it comes. And I think we are just getting into this, you know, I'm bigger than you, I grew faster than you, and so there's too much of that going on. I think in India there's a real psychological change, and I worry about it sometimes, right? That it's more about, am I bigger than you? Can I get bigger than you? There's more personal ambition, personal visibility. And I think that's crazy. I mean, that's why I like RBI when they say change your CEOs every 5 years, and now even NBFCs have to change CEOs. I think he's right. There's no point having one person or founders and CEOs being for such long term and do not take adequate investments in their companies to tackle the future. They're all worried about current. So I think this is, I mean, I don't think it's a good sign. Look at China. They're immune to the world. They're doing what they want, and they're getting just so ahead of everyone. So I don't know. So I don't want to sound
what
too
would you
cynical,
like, as
but
an economist, what would you like to borrow from China? What policy?
remember you're representing Goldman, so you're going to get quoted.
Yeah.
Be careful, okay?
What from the policy playbook would you borrow from China?
I think you know, you can't sort of compare political structures in the two countries. So we've got to be very careful about what you want to borrow from other countries. I would just reiterate that the state level reforms are super important. Don't expect big bang, you know, sector level or you know, sort of sector changing reforms in India. Agriculture has been difficult. You know, land, labor has been difficult, right? So if you do state level reforms and if you're able to execute that at speed with judicial capacity, that's the one which is going to get entrepreneurs growing at the ground level. It's not so much. I think newspapers look for a headline on, you know, one big sweeping reform coming from the central government, which will just be the magic wand which will change everything for India. The political structure is very different. It's not, the constitution is set up in a way that one big sweeping reform cannot really change everything.
And that's why some of the states in the south are doing well. They're actually marketing themselves, and they have, I think, much more successful FDI going into some of the southern states. And he's right. I mean, you know, these are many chief ministers. They're like mini prime ministers, and they're doing a fantastic job in some of the states.
Yeah.
And they're attracting real capital. I mean, you look at the whole auto industry is gone there. Shipbuilding is going to start in Vizag. There's a lot going on there. So I think, you know,
Sanjay, put your 2030 hat on. What's it looking like? Are you still banging your head against the brick wall about the same problems, or is the environment improved? 2030.
I think 2030, the government's efforts in the last 8 years on the Gati Shakti, the whole intermodal connection, I think logistics costs will come down significantly. I think power costs will come down given the concerted power planning they're doing. So I think the factors of the cost of some of these factors will reduce, which will at least make us cost competitive from manufacturing point of view. I'm just hoping that folks start reinvesting in the country, even if the local consumption remains where it is, hopefully capture the export gates that have been opened up by this government. I mean, we're signing so many FTAs, and of course, it's a two-way trade. If we sell, we have to also buy, right? So just to be clear, it's not like just like be thrilled about it. So I think if they can capture, if we can make manufacturing more competitive, even the foreigners will come here. In fact, I do travel a lot on this regard. A lot of the foreign SMEs, and their SMEs, by the way, are $500 million in size, the ultimate in industrial automation and all that, they want to come to India, where the Airbus supply chain is moving, want to manufacture in India, for India and for exports. But yeah, so I think by 2030, my wish, and I think a high probability, we'll get manufacturing much easier with some of the reforms that are going on. Cost of factors will come down because of the logistics and the power effort the government is putting in. And with the FTAs opened up, so many FTAs done, we should be exporting as much as we can, because we have not the tariff advantage, but we have many other advantages. Okay, we got skill, we got cost on our side. So my wish list is that in the next 4 years at least, export becomes a big driver. But I just want you all to remember, to get exports, you also need a lot of imports. So I think your rupee will remain under pressure. I don't want to predict where the rupee will be, but I would say, like a private equity people, you underwrite 4.5% depreciation every year.
2030, final words.
Everything that Sanjay said, plus a settled world in terms of trade. You're still going through a big churn now. So, just discount these 2 years.
Do we think we have a settled world in 2030?
You have a settled world. I think the world will settle down to the new trading regime. The world will settle down to AI. I mean, we'll get our heads around, what AI really means for the world. 2030 is 4 years out. And then hopefully Sanjay mentioned the FTAs that you have signed, that comes to fruition by then. And you have the reforms working in full capacity. So, hopefully you're back to higher growth by 2030.
Gentlemen,
you'll be able to buy French table wine for 400 rupees after October. Why would you buy Sula? Yeah?
Big round of applause. Great chat. Fantastic chat. Thank you so much. Thank you. Thank you very much. Let's have a photo. Thank you. Thanks. Thanks very much. Good. Right. Right. Tech Titans. Let's get Paroma up here. Paroma Chatterjee, CEO, Revolut India. Big round of applause. Come on. Thank you very much. Come and sit here. Come and sit next to me. Otherwise, I'll feel lonely. Hi. How are you? Right. I think we've got 10 minutes, so we'll squeeze as much as we can in. Hi, Paroma. Thanks for coming in. I mean, India operates in some of the more mature digital markets in the world. I mean, Revolut does, not India. India is one of the greatest digital markets in the world, but you operate in all of them. You're a fantastic global company. When you look at India specifically at its stack, as it's called, its UPI, its account aggregator, its data framework, where does it lead from Revolut's standpoint, which sees everything? Where does India lead when it comes to its stack? And maybe where are the gaps that it needs to fill?
Oh, I could keep talking about this, but to try and keep it brief, I think when we were first looking at which markets to expand into and to expand into India, the thing that stood out was the digital and fintech adoption rates from the consumer lens. Like having 87% of the citizens of a 1.6 billion population country already using some digital platform or the other created a fertile landscape for us to enter into. Second, the fact that we have payment rails which have already been integrated in the form of UPI, which is being used by close to 500 million people, that was an interesting localization challenge for Revolut, that it's not the traditional network rails of a Visa, MasterCard, etc., but to create a QR-based specific payment rails for this country was a very interesting challenge to take up. But once that is done, I think the company has become aware of QR-based payments as a seamless solution to be implemented elsewhere in the world by looking at India as a case study. So that's sort of the second angle. And the third, the pace at which this kind of India stack infrastructure is growing, whether in internationalization, like the UAE corridor, the NBD person spoke about that a little while ago, or the Singapore corridor, or the recently launched France corridor, which enables a player like Revolut, which is present in the UAE, in Singapore, in France, to be able to enable consumers to do seamless flow of money into India, out of India, for both the retail segment as well as the business segment. Now coming to the challenges, which Sanjay very eloquently articulated in his earlier session as well, just the fact of localizing the entire tech stack and the data stack for India, that puts an existential entry barrier for most global companies looking to come into India, apart from the policies and processes that people spoke about. So I think one of the things that can help is a lot more cross-border collaboration on regulations, recognizing each other's KYC or electronic KYC. A consumer who has been KYC'd under FCA PRA's regulated UK bank is a valid consumer who should be trusted by RBI as well when they're coming into India to want to transact using UPI. Like when you
Can you see that coming, more cross-border collaboration?
So
or do you have to, are you pushing for it?
So we are part of cross-border committees, again, under the India-UK FTA as well, where inter-regulatory conversation has actually started to think about like a financial passport. The way you have a passport, which is recognized by the entire travel sector, whether regardless of what is issued by different countries, and then they layer their visa requirements on top of it based on that country's priorities. A financial passport, if you will. What is the KYC that issued by a particular country is accepted by everybody else, with maybe a layer or two on top, which is a visa equivalent to have harder recognition or regulation.
Let's talk AI. We've spoken 4 minutes and we haven't mentioned AI. That's not good.
How can you talk to me and not talk AI up to now?
Where's it moved the needle most for Revolut, would you say, in the last 12 months? Where's it literally moved the needle? Give us an actual example.
The actual example, okay, in terms of hardcore numbers, there are folks here. How many people does HDFC employ in India? 2 lakh people, close to 2 lakh people. Revolut is a bank in 44 countries. Do you know how many people we employ globally? 10,000.
Wow.
That's your hardcore numbers.
Yeah.
If you actually allow technology to lead most functions. So 72% of our processes are run tech first, starting from credit underwriting all the way to our financial transaction monitoring and obviously support. AI is not just a chatbot answering customer queries. AI is embedded, a fundamental way of running your business.
Is it moving too fast? AI regulation. I know that tech always moves faster than rules and have to catch up, and it's all a bit tricky. How far ahead of regulation is it? Does it need to catch up regulation, and what do you want to see?
That's actually the question of the decade, Mike.
Right.
I mean, how fast is innovation moving, and is it outpacing regulations? I think what is needed is more, how do I put it? Up to now, I think companies which have been using tech, particularly in the financial services sector, have been doing post-dated compliance. So they're expecting a regulator to set out a particular guideline and then figuring out how to comply with it. I think it cannot be post-dated. It has to be co-created now in this new regime between regulators and industry to come together and create digital-first guidelines. Because if you think about it, one of the things that I think is needed is supervisory tech. I don't think anybody's thinking like that. What a regulator needs is not quarterly reports from us as companies.
Yeah.
They need real-time, anonymized feed so that they can monitor real-time, make more intelligent policies, as well as take action.
Is that happening?
I don't think we're moving quite there yet, but I think we'll get there in the next few years as they start seeing the pace at
Supervisory
which
tech.
yeah, soup tech, if you will. If I want to throw a jargon into this industry, there are thoughts around it, initial thoughts, but we need to see some experimentation and then implementation around that.
Wow.
The second aspect is more, I mean, we spoke about cross-border collaboration, but if you think about it, in today's world, it's sharper. In a physical world, the geographical boundaries are drawn really, really tight, right? But in a digital world, there are no geographical boundaries. There are none. It's one uniform digital world out there where the entire digital citizens from across the world inhabit. And therefore, the digital risks also don't have boundaries. And therefore, it becomes even more imperative for people to have cross-border sandboxes and cross-border sharing of data. So if a customer is considered risky by one regulator and one geography or one government, that information should be available for other countries to also decide on. So I think more cross-border sandboxes are also needed to look at this world digitally where the geographical lines are actually blurred.
Yeah.
And the third is more real-time automated protocols. Again, from a risk or supervisory or regulatory lens, if, let's say, in case of a cyber offensive, right, from anywhere in the world, you need to have centralized global automated protocols which can actually flag to any other country or any other issuer or any other financial institution to take appropriate action, and that should come to all regulators. So I think it has to evolve towards a supervisory tech that is talking cross-border, that is talking automated protocols, rather than physical geographical world silos of regulations.
Let's spend the last couple and a half minutes looking forward to 2030, Paroma. You've spoken eloquently about the reach, the digital reach in India. What about the wealth? Is the reach creating wealth, real wealth creation for ordinary Indian households? Does that change by 2030? Because people often ask, not just does digital create wealth, does it give us universal access to credit, to insurance, to wealth? AI can do that too, so that's a big mash of a question, but you know where I'm getting.
Okay, it's a big mash of a question. Let me try and break it down into
Yes.
different components. I think one of the areas where AI can truly disrupt is genuine credit underwriting. It has been traditionally manual underwriting philosophies which have been coded. And there's a difference between AI and coding in tech. AI is not equal to machine learning, okay? And I really want to put that out there. AI has the ability to understand context. AI has ability to read data beyond traditional balance sheets and bureau scores and create an automated score. That's not AI. That is ML, right? AI has the ability to look at real-time inventory data of a business, the health of their B2B SaaS subscription, their social indicators of founders and CEOs to be able to give a contextualized credit underwriting, which I think is one of the biggest deblockers that AI in credit can do and bring the cost of credit down. Because today, we spoke a lot about capital availability and funding in the last two sessions. One of the reasons to me why cost of capital is so high is as I call it, the uncertainty premium that is put by everybody from the government to private equity to VC to lenders or NBFCs, right? You bring the cost of evaluating your risk down, you automatically bring down the cost of capital. So I think that's the one big thing that AI can unblock. The second, I keep going back to geographical lines. Today, if you look at the world map of capital flows, the capital pools are still largely in the West, right? But if you look at the high growth regions are the Indo-ASEAN region. and the ability to do low-cost capital infusion to bring the capital from the pools in the West to the high-growth markets in Indo-ASEAN in a span of seconds and at low cost is really going to change the world map of how capital flows. I think that's the second thing that AI can really disrupt. The third thing coming to the individuals today, and there was allusion to that as well, right? We have 5% of our GDP lying in bank accounts. Traditionally, the measure or the metric of financial inclusion is how many Indians, and I'll put it in Indian context, have bank accounts, and then it evolved to how many have bank accounts with balances in them. Today, we have over 1 trillion Indian rupees lying idle in low-interest savings accounts. And that, aside from the private industry, the individual savings is not finding their way into institutionalized capital, which can be deployed by companies for growth. One of the ways of doing that is fractionalization.
Yeah.
Right, apart from easy access. The ability of a Mumbai-based small saver to be able to invest, let's say just 500 rupees or $5, if you will, in a US Treasury bond, owning a fractional share, or green infrastructure in Arunachal Pradesh in the Northeast.
You can already do that with Bitcoin,
You can do
can't
that
you?
with AI. Right? So these are the kind of things which bring fractionalization into it, and the ability to have small ticket investments can actually systemically bring this idle savings which are lying in savings accounts into wealth creation, both for companies as well as for individuals, and get a healthy flywheel kicking overall. The other interesting aspect that AI can throw up is gamification.
Yeah.
Right? The way AI throws up recommendations for your favorite song next when you're listening to a playlist, or a favorite movie on a channel that you're watching. It can actually, that same logic or theory can be used to recommend the next diversified fund you should be investing in a gamified fashion to make it everyday life for the user rather than something they think about once in a year after they've got their bonuses. And I think that's going to be the fundamental change.
You're playing a game and it says, buy the FTSE, blah, 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 blah. Brilliant. 5, 10 seconds, 20, 30, what do you want to see in your space? India, digital space, money, wealth. What do you want to see? What do we need to get there?
I think 2030, India is going to become the world's largest digital infrastructure lab. We've already proven that with the initial India stack, but I think the way the capital flows are moving, tech is moving, consumer adoption is moving, and most importantly, the SME, the small business is moving in India. I think this will be the world's largest digital lab that the rest of the world
We
will
will
start
hold
learning
you to
from.
that in 4 years.
I am contributing to that. I'm happy to continue contributing to that in the next 4 or 5, unless what Sanjay said, RBI comes up with a regulation that CEOs of banks should be recycled every 5 years.
Yeah.
If that doesn't happen, I'm still going to be there in 4 years' time.
Brilliant.
to
Give her a
talk to
big
you
round of
again.
applause. Thank you so much. Thank you.
Thank you, Mike.
Thank you. Right, quick photo. We're moving on. Right, with Tech Titans is continuing. We're discussing the Maharashtra model. Let's get onto the stage. Kaustubh Davse, Chief Advisor to the Chief Minister of Maharashtra. Thank you very much, sir, for coming up. Good to see you. Thank you very much. Have a seat. Right. Now, there's this global race taking place, and there's a domestic race in India and globally for tech leadership, for AI leadership. No one knows that better than you. Where does Maharashtra stand in that race, not only within India, among Indian states, but the world right now?
Maharashtra is
the India leader when it comes to, especially when it comes to AI, primarily because we were the first to adopt and create an AI Center of Excellence way back in 2018 with the Vadhvani Foundation. It was inaugurated by the Prime Minister. What we very early realized that AI is definitely going to reshape the economy. And the fact that we are a $660 billion GDP state with a significant portion coming from services. So we realized the fact that there is going to be an immense infusion of AI-led technologies which are going to reshape businesses, most importantly, improve efficiency at scale. But that posed a very interesting challenge for policymakers like us, that what does it and how does it impact a population which is 65% less than 27 years of age in our state, and 50% are in K-12. So we were early adopters. The Chief Minister led this from the front. We set up the Center for Fourth Industrial Revolution by the World Economic Forum in Mumbai. We also in a very open fashion, with open arms, accepted the various initiatives that were driven by AI companies. In fact, we extensively use AI in governance. Yesterday, the Chief Minister was at the leaders' dinner where he elaborated this in detail. In fact, we have an AI tool in the Chief Minister's office which, so typically when the file moves across various different secretaries, it takes a very long time for somebody to kind of review the file and then finally make the comment and recommend to the Chief Minister whether he should not sign. And the AI tool just goes through the whole 3,000-page document and makes a quick recommendation. So we're training the model even at the highest level in the government. So I believe that...
So how far into government, into the actual machinery of government, do you want AI to move? Is it moving?
I think there are very specific application areas. We believe agriculture is a very important area for very widespread AI adoption and application. We already have a very large AI agri stack. We have more than 30 lakh farmers, 3 million farmers on that app, and every day advisories and photos are being taken and advisories are being sent to them. It's in multilingual. We also have partnership with OpenAI, we have partnership with Gemini, we have partnerships with Sarvam, which is our homegrown AI LLM model. And we are right now creating the sandbox and deploy data for 12 departments to train models. So we are increasingly accepting the fact that there is going to be a widespread adoption of AI. And in fact, in the Chief Minister's office, people's efficiency have gone up significantly.
Have they?
By using applications for minutizing the meetings, for preparing notes, briefing documents. And I have seen bureaucrats who have spent 30, 35, 40 years, even at the initial level of undersecretary, and their enthusiasm of the product that is getting generated through their contribution to the inputs of the AI. And then that really kind of is making them feel, wow, I mean, this is something that really has come from me. Eventually, it does come as a combination, as a partnership between them and AI. So I believe that there is going to be a widespread adoption, and we are doing it in phases, and we are preparing ourselves for not a takeover by AI, but like a simultaneous
And I wanted to
adoption.
get to this, a takeover by AI, because that's the fear. We're going to be taken over by it. Jobs are going to be decimated. We're all going to be living on a universal basic income. Reality or not?
No, I think it's definitely something that is going to happen. Certain jobs are going to be impacted at scale.
Yeah.
The opportunity we see in this is that for us to kind of train people to move them on the higher level of human resource. We believe that being the youngest nation on this planet, we will probably be the human resource for the world. And what that essentially means is that a very large pool of engineers, developers, the whole ecosystem which AI necessarily needs, including the data to train the best models in the world, is all going to come from India. And we see that as an opportunity. Even the Prime Minister's office, when they decided to the AI Impact Summit, if you look at the speech of the Prime Minister and some of the leadership across, they acknowledge the fact that India is going to play a pivotal role in defining how AI kind of takes over various different businesses. And I think we are ready for that. We are looking at it in a phased manner. There are certain things that we can't predict. There are certain businesses that are going to get wiped off completely as we anticipate. But
there's a real software fear right now, isn't there? If you look at the markets every week, especially ahead of what's been happening with Iran for the sort of month or two before, every week a certain subsector of the equity market was being decimated because, AI is going to make this industry defunct and just obliterated.
I think that's a doomsday prediction.
Yeah.
I would say that I think as a policymaker, in our entire lifetime, this has not been the only time when such an advanced technology is kind of challenging conventional norms. It has happened before as well. The modicum of which AI is really kind of evolving itself is far more faster. So we are unable to keep pace. So what we kind of start to think today may necessarily not be of relevance in the next few months. But having said that, I believe that we are well equipped and solidly, we are playing on the front foot, if I use the term of cricket, and we are making sure that we use it for the best of our citizens.
So what does that ambition look like in practice? 2030 is our big thing. Looking out to 2030, what capital is going to look like?
I think we are going to make AI work for us and not the other way around.
Right.
I think we are going to choose AI deployment at scale in areas where we fundamentally believe it's going to really, really create an impact. Agriculture, health, urban infrastructure. Its ability to conceive and reduce the time of implementation is the single most effective, efficient use of AI. And I think, again I'm saying, at the cost of repeating myself, as a policy maker, you have to be very widely awake to the fact that there could be large scale disruption that may happen, and you need to be well aware of it, and at the same time provide the necessary impetus to train the manpower to be able to be redeployed at a higher level. I think it's all good.
I've got to chuck a question on Starlink at you, if I may, because you became the first state in India to welcome Starlink. It's a big decision, both politically, practically. What drove that call, and what does it mean for the state?
So obviously, India today, in terms of teledensity, is more than 100%. We don't have a connectivity per se issue. Data is not an issue. In fact, we believe that the speed of data and speed of travel are two fundamental pillars of a $5 trillion economy for India and a $1 trillion economy for us by 2029. But having said that, there are certain very visible blind black spots which traditional telecom infrastructure is not able to address. For the lack of the technology itself, for the lack of intent, and for lack of capital, because the ROI math doesn't sit. That is where I believe there is an immediate traction for technologies like Starlink to come in, and I have been deeply engaging with them for the last 6 to 8 months, having found out a certain set of locations within our state to make sure that we deploy faster. I believe that Starlink is a fundamental game changer. It's a great technology, and it is going to provide us that necessary impetus to make sure that the Digital India initiative under the Honorable Prime Minister is truly achieved in its true sense. It is going to shake up the existing operators for sure.
Of course.
But having said that, I think, again, I've said that, the same thing, this was what Jio did to other operators when it came on board. And they really provided, and it's a great service. Jio is a great service, and so are some of the other operators. So I believe that this competition is essential for the citizens, and I believe that Starlink has a very, very important role to play. Provided they clear all the security and the necessary clearances, I think Starlink is here. They will stay, and they will, I believe that they will be successful.
Now, you lead the Chief Minister's War Room to accelerate key projects, driving digital infrastructure, foreign direct investment, public-private partnerships to advance the state's economic growth. What keeps the war room brain awake at night?
Yesterday, the Honorable Chief Minister gave you an insight into his own mind. He's extremely impatient. And his impatience comes from the fact that he believes that there is so much that we have to do. And in this term of his, we had a very short conversation saying that how long are we going to do this 18 hours a day, days? So he just pointed out and said that China is almost 30 years ahead of us. Till the time we are closing in, we have to continue going. So so he has a razor sharp focus on what he needs in terms of his vision for a progressive and a inclusive Maharashtra. And that becomes an inspiration for us. And I think the fundamental pillar of that is that we have to address infrastructure at scale. So we are right now deploying $57 billion worth of infra projects. The second very important piece for him is to make sure that we are able to do what is right. So and I say this in many forums, there's a line that he always gives us. He says that for businesses, the most profound challenge is that, to do what is right and yet remain profitable. And then he points to himself and says that for political leadership, the biggest challenge is to do what is right and get elected. So I think the fact that we have somebody who is very, very intensely focused on doing what is right for the state and the country at large needs to be empowered with the necessary support. The war room team essentially helps implement that vision at scale. And that keeps us awake all the time.
Thank you. Kaustup, thank you very much indeed.
Thank you.
Big round of applause. Thank you. Thanks a lot. Thank you very much. Yeah, 4.5. We are moving swiftly on. It's Market Mavericks. We're moving on to another topic. I want to introduce Shiv Segal, President and Head of Nuvama Capital Markets, who's going to be moderating the next couple of panels. Have fun.
Hi everyone. Very good afternoon, Mark. Thanks. You've been doing a fantastic job throughout the day. I have the privilege and the honor of having a fireside chat with someone who's not only been at the forefront of what the capital markets, everyone has been discussing since morning, what's been happening over the last 30 years. Yesterday at the NSE, we celebrated Nifty 50's 30-year existence. And I get the privilege of welcoming someone who has not only pioneered the technology, the infrastructure, but the entire evolution of capital markets. And without much ado, sir, please, I would like to welcome you, Ashish Rohan, MD, CEO of NSE. Thank you so much, sir, for doing this. Sir, firstly, congratulations for yesterday. Great event. And thank you for hosting the IGF. I'm saying this on behalf of Manoj and the entire team. I would like to begin. You gave some very impressive stats yesterday. I've been hearing a lot of panels since morning, as some of you have been. And I think there's been a lot of bearishness since morning, given what's been going on for the last 15, 18 months. And I thought I'll just put things in perspective. Yesterday, sir mentioned a very important stat. The Nifty has grown 67x since its existence. And that's almost a 13% CAGR in INR terms. And while Asia has seen many, I think, growth stories over the last 30 years, we started with the tiger economies pre-2000, and then we have had Korea, Taiwan. Currently, we're seeing a similar thing in Japan. But I do want to remind everyone that India remains a very particular anomaly for investors. It is the only growth economy where GDP has actually resulted, GDP growth has resulted in shareholder returns. And if you look at a 5-year, 10-year, 15-year, 20-year metric, you know, Nifty has been outperforming its Asia peers and EM peers in USD terms as well. So just things in perspective, what's been happening last couple of years. But here, sir, the point here is you've been at the forefront of this. You've seen a massive journey, a very successful one. And over the last 30 years, you made some very important decisions, both at NSE, BSE, and now heading back at NSE. When you look back over that evolution, what at that point of time, the key thoughts or decisions you made, what were the biggest transformations that you have seen? And we would love to hear your thoughts on that.
Thank you for calling me. I think the technology part is what is impressive, what dazzles, but the numbers are quite astonishing in terms of what technology has done for India. When NSE started in '94, we had probably 1 million investors, even take a few more. Today we have like 140 million investors, right? So, today on a good day we do like 20 billion orders, which is 50% of all orders in the world. On a good day we do 300 million trades, which is 50% of all trades in the world in all stock exchanges put together, right? So, and we have investors of NSE, which are like 127 million investors, and NSE investors, which are unique. We have 250 million plus accounts. And NSE investors are now there in all pin codes of India, other than some 28. And we have people in Ladakh, and we have people in Andaman, Nicobar, and in Arunachal Pradesh and Dwarka. And so all nooks and corners of India, we have investors. Jandan Aadhaar Mobile has helped. NSE is what brought the technology to India of any type, which was a mass scale and gave that confidence to India and Indians and also the rest of the world that Indians can do these projects in addition to changing the way India does trading in stock markets. But I think the story which has not been celebrated is not the equities or derivatives. It's basically what I call corporate governance. There has been setting up of SEBI was a very important sort of activity, and giving its power in '93. It had to regulate in favor of small investors. But the way I look at it is, today also I had students from abroad, especially US, asking me questions at NSE about how do you differentiate between, say, US markets and Indian markets. And I said, and not only US and India, but also European markets or any other markets, is basically our way of doing corporate governance. I mean, if you look at, we have all shares which are pari passu. US has golden shares and special rights shares, and which ends up affecting everyone's rights, So basically for me, we also have the framework for related party transactions, majority of minority. These are things which are not there across the world, right? So we have we have erred on the side of the investors. In my opinion, there are two situations which happen in corporate governance. One is asymmetry of information. That is, the insiders have more information, more quicker information than the outsiders. So the regulators have focused on saying that how do we minimize that? It cannot be eliminated fully, but how do we ensure that the information is quick and correct? Any rumors, any material information, quarter results, and if you don't disclose the information twice in a row, in 2 quarters, third quarter you get suspended, and few more quarters you are delisted, right? And so that information asymmetry we have tried to reduce largely because of SEBI's corporate governance framework. But asymmetry of power, that is, insiders have powers to give contracts to their friends, relatives, or their own subsidiary companies, and that we have tried to reduce by doing this majority of minority. So these are the SEBI sort of activities which we have not focused on, not celebrated, But that is what differentiates between, say, Indian markets and say Chinese market, because the contrast is like large. In 20 years or 30 years, China has grown like 10x. Their index has remained the same. Whereas India, in 30 years, India has grown probably 6x, 7x. But the index has gone from 1,000 to 25,000. Plus, if you take the dividends, it will be 30,000, right? Because the insiders in India have the list flexibility. They don't like it. And there is tremendous pressure on the regulators to relax all that. But the regulators and the government both. And 30 years, we have had many types of governments, not one type, right? And all of them have supported this framework that if India needs to have a well-functioning capital markets, we need to basically level the playing field in favor of the small investors, right? So everything which SEBI has done, and I think that is the least celebrated aspect, because you can dazzle people with all these nanoseconds and microseconds and billions and trillions, but the outcome is $5 trillion of market cap. NSE started with where India had like 380,000 crore market cap. Today it's like 4 lakh. To ensure that the people don't see the machinations behind the corporates. Like Walmart family might be running it, but they need a CEO who you end up paying large sums, and then that guy gets criticized for having a large salary. Of course, all of us as CEOs, professionals, would want to have those kind of salaries. But in a way, they are punching bags. The families are still running those shows. In India, we have taken away that mirage. Straight away, we tell promoters that you show your face, whoever is calling the shots, and be responsible, not you, but your children and children's children will have to be responsible to the investors. So for me, ours is what I call a promoter-driven capital market, entrepreneur-driven capital markets. Theirs is a show of a professional government.
You made a statement yesterday, it's exactly similar, that we are a trust economy, right? The job of every market intermediary and the regulators and the exchange is about trust. So a lot has been discussed. Mark has been asking every panelist about this, the retail growth story phenomena that India has been going through. From a regulator, from an exchange point of view, are you also viewing this as an inflection point? You talked about the numbers, the number of demat accounts that have grown. And do you think India has seen that revolution? And there's a lot of comparison in the financial press about the moment from what happened in the US in the 1980s with the 401ks. Are we also viewing it from a similar angle? Would love to hear your thoughts on that.
No, 401k was a kind of a tax framework for government giving incentives to invest. In India, government is not giving incentive to invest, right? It's the pure play, the returns which Indian markets have given, right? So if you take the slice of say 5 years, 10 years, 15, 20, 25, 30 years, any slice, you'll realize that comparable asset classes like fixed deposits or gold or real estate have not given returns like the way stock markets have given returns. And broadly speaking, in absence of ability to predict future, people go by the past performance of any asset class, saying gold has given returns, great returns in the last 2 years, so probably it'll give more returns till the time that stops giving returns. So all of them pile on to that. But I kind of give an example that you are putting money like 10 lakh in say 1995 on say fixed deposits, and your neighbor puts the money in index like Nifty, right? Today you would have got like 3 crore or 5 crore if you were putting in Nifty. Your neighbor would have got like 2 crore after tax would be like 1 crore 20 lakhs, right? So that's where the difference, slowly people talk to each other, people figure out that using the same money, that person is getting better returns. So that's where they come in, and then that slowly starts investing more and more into the stock market, which becomes in a way a virtuous cycle, right? It could also, when it stops, like today, people have, but there have been instances like in COVID times, the markets went down by 40%. In a month's time, right? And before that, during global financial crisis, again, 40%. And I was giving an interesting example today to somebody else, saying when COVID happened, Mr. Modi came to the television at 8 p.m. usually. And on March 23, 2020 or some such date, on a Sunday, he said, India will be closed down now. Just now, after this second, nobody can come out of their house, right? Many of you who are old enough will recall that, right? And next second, I was CEO of BSE then, I put a tweet saying, markets will remain, BSE will remain open as usual. And I started getting tremendous amount of negative feedback saying you are going to kill people, you are money people, I don't get any bonus out of no such thing. I mean, I don't get bonus only, right? Nor stock options. And 1/3 of my actual variable pay is kept so that after 3 years, if they find something wrong, they'll stop that also. So I am running on a severe negatives all the time, you know. But still I said, tomorrow market will open as usual. And then after few hours, the information would have gone to the regulatory authorities. They called up saying, "Arey, तुमने ऊपर बात किया क्या दिल्ली में?" And I said, "No, I have not talked. But if you want to stop it, tell me. I will take it back. I will apologize." So, and then I said, if you have to do the settlement, because Friday people have traded. People need money on Monday when they have to go to hospital, right? If a 100 rupee stock is there, even if it's giving 25, it's still 25 more than zero, right? If I close down the markets, what will happen? If I can't give liquidity for a market which is essentially for liquidity, it's going to create a problem. Of course, I had a background to that other people did not have, because we were discussing with Delhi, and first time in independent India's history or ever India's history itself, stock markets were considered elitist game, right? Rich people's place. But 1 week before that, government came out with a notification of what is essential service. They were preparing for the close down. And there, on our request, they had made stockbroking as essential service. Can you believe even today that stockbroking is essential service in India? Right? Government of India, before announcing, they had 1 week before that, so I knew that they want me to keep it open, so I was like very confident to go and ask. But the fact is, India kept its market open. It's not that all markets kept open across the world. Some markets closed down. Markets came down, but that 40% down, once people figured that, like gold, when you are in trouble, you put the gold in the market, next guy will give you at least 10%, 20%. Similarly, this market could give you that liquidity, and that's where people got more confident. And we went into COVID with 2.5 crore total investors or less. Today, after 6 years, we are 14 crore, right? More confidence, more information, more trust of liquidity being available. And those are the things which we have not celebrated, we have not discussed. And naturally, you are our member, right? But you don't look at it that way because nobody pointed out, right? So you need to appoint some good analysts to also celebrate SEBI and other people, right? We don't do that. This guy is, we worked through the night because all the banks had to close, right? Because banks can't be opened. So we had to say, if banks are closing, you close the ATM, but my electronic movements has to be there. We work through the night with brokers. On normal day, we do 10 o'clock settlements, that is payout. But on that day, we did 9:30 and we announced that today's settlements are over. And that is basically what all the entire ecosystem of all 1,000+ brokers, exchanges, SEBI, RBI, all banks. It's a great ecosystem we have created where people don't look at whether they will die. Literally we were wearing those astronaut suits every day and going to office. And BST was running, I had to tell Kaustubh to send me a BST bus. Like we had 3 buses, like one from Vashi side, one from Thana side, and one from Borivali side, running only for BSE employees and similarly for NSE employees. And then each person had to sit in different seats and different rows and stuff like that, you will recall. So that's how the coordination with governments and everyone else has to be done.
So, sir, one more thing. Mark has asked almost every panelist, when we look out for the next 5 years, what makes you the most bullish on India? But my question to you is slightly different. what would make you the most happiest or proud person as a pioneer of capital markets in the next couple of years that you would like to see a change in, or the growth aspect of it?
For me, see, we are directionally correct. And what are the roles markets perform? Again, when I think of it, where is India? And what we have achieved, what we will achieve, whether 2 years, 5 years, 20 years. For me, I have to be directionally correct, right? How do I scale up good things? How do I scale down the bad things, right? And so when I look back, last 100 years, that is the 20th century, was a fight between capitalism and communism. Capitalism finally won, right? And we thought communism lost, right? That was 1989. The Berlin Wall failed, right? USSR broke down, all perestroika and glasnost and whatnot, right? And for me, when I look back, it's not the capitalism that won, the marketism that won. Today, the communist societies, China is a communist republic, it's a market economy. Vietnam is a communist republic. Every place then you see something in front of any sort of building, and I asked that person saying, what is it written? It's Communist Party in their language. So the communism, capitalism, and we are like socialists somewhere in between, but what is running is markets. So if we have learned as an economy, as a society, how to create good markets, how to run them, how do now, and what do markets do, right? Many of us think the markets have basically they allow you to do trading, that is transact and then do settlements and all. For me, the biggest function of a market is actually price signaling. I mean, like today, we are sitting in Lower Parel and Mumbai, right? And somebody says the price of a per square foot good quality housing here is say 1 lakh rupees per square foot. You don't have to ever trade. Your forefathers might have bought, and still you are an investor, and you require that signal, right? How much is my wealth? So similarly for a vegetable market, similarly for all assets of different types, the markets perform a function, and if we at NSE and the regulatory framework have learned how to create good markets, well-functioning markets, we have standardized equities, equity derivatives, now bonds, commodities. Can we go and improve electricity markets? Electricity markets are very large, although we don't think of them as markets, right? So last year we launched electricity futures market. The prices of spot came down 40%. It gave government ability to do coupling on spot markets. Okay, I'm just giving you, and then people went to court saying somebody else leaked it and that's why it's not allowed and stuff. But for me, now we are trying to organize spot market for coal. Coal is a very large activity for us, right? How do I, so for me, why I leave is basically like, how do I create better markets for the society? Because markets are going to give you transparent, fair, efficient, orderly framework for running all the economic activities on, not even non-economic activities. Like we have a social stock exchange where you want to donate, you will have a fair, transparent, efficient, orderly market for donation, right? And so for me, how do I leave? Why do I leave is because I want to create markets which help India. And so, and create better markets which does not sort of give more powers to one set of people vis-a-vis others, right? Insiders versus outsiders. And so asymmetry of power, asymmetry of information, which is what I try to minimize. It cannot be eliminated fully, but that's where, for me, India's future is bright, because if technology is going to the only change that is going to create wealth, India is a pure play technology country, right? I mean, although our roads may not look like that, but your mobiles show you that you are the best in technology, right? And that's where if world is going to create wealth like many-fold, because technology waves are coming faster and faster. And so wealth is going to get created faster and faster. Which societies can create those wealth? The societies which are adaptive. You don't have to invent. You don't have to invent those technologies. Like the Western countries did not invent decimal system. But they used it, they adapted better than us, and they came and subjugated us. Similarly, India did not invent computer chips. It did not invent Unix. It did not invent computer languages or databases. But we were the best users. We made use of it for ourselves, but also for the rest of the world. So if AI is going to make it, or the drones, or 3D printing, or biotech, we are the technology adaptive country, right? We are, and which societies can adapt to technology faster in the long run? The ones which are younger. Young societies, young people learn technologies faster, right? And so you look at the world and scan it, like Japan is old. South Korea will become half the population in the next 40 years. They are very small, but still they have become old. China is going to be half their current population in the next 50, 60 years. Then India comes, which is technology adaptive and young. It will remain young for next 50 years. You have two young countries, both left and right to you, but they want to go and live life of 1400 years back, right? They don't want to adapt to new technology, right? So give it up. Go to Africa, it's not that stable. Go to Europe, it has become a museum, right? Old museum. You want to have good air, go there, but work here, earn and go there for sort of good air, right? And then you go to America, it's becoming old if Indians don't go. 2025 had less number of people in America than 24, literally physically. So this is the only country which is going to remain young for next 30, 40, 50 years. And if technology is going to create wealth, and we are the top of the line adapters of technology, huge wealth will be created. But how do I allocate those resources? Which technology to bet on? That's where basically the markets come. And for me, earlier you required a lot of money to create more money, which is capitalism, right? Now the new framework is you require little capital, a lot of brains, a lot of exposure, a lot of technology, and you can create more capital, right? So Nandan Nilekani proved it, Narayan Murthy proved it, but then now Zomato and Swiggy and everyone else is proving, even you proved it, right? So for me, this examples tell you that small little capital can create great capital, right? And I need to provide, because we have been made to believe that trespassers are getting funded in IT or AI. That is not true. 1 out of 10,000 get funded, and they get celebrated, written down, because the PE, VC, all of them spend more money on getting things printed in Economic Times third page compared to giving the funding, right? For me, if you don't get funded, you come to NSE. I have 12.7 crore investors. Even 1,000 of them are putting money in your ideas. You will still get 5-10 crores. And you will be able to make it big sometime, much bigger than you can imagine. And that's what, how do I create those markets so that capitalism without capital flourishes, and then the entire framework of resource allocation by economy is taken care of by the markets. Today, we think bankers will do it or the policymakers will do it. I think markets will do it. And that's the best way to do it. But then we have to have markets which are actually correct and also making the level playing field, right?
Thank you, sir. I think a lot of budding entrepreneurs have been here. A lot of established entrepreneurs are here, and they're listening to you. And I think we can go on and on, but the IGF team is giving me stares because the next panel is here. Sir, thank you so much. It's always a pleasure. And we really, really appreciate your insights. And on behalf of everyone, I want to thank you. Thank you so much, sir.
Thank you, sir.
Perfect.
Thank you.
Sir, So everyone, a lot has been discussed on pricing and how to make money in markets. My next panel is exactly that. So if I can please invite all the market mavericks on stage, please, it would be an honor. Okay. Lakshmi, why don't we start with you? Yeah, please. I know you have a long trip back in the evening as well. We'll try and make it quick, don't worry. Swaroop, sir. Please welcome us on stage. Anand Narayan sir, it would be a privilege if I can see him. And I get the privilege of chatting with Andrew 2 days in a row. So thank you, sir. Thank you, sir. Thank you for doing this. Perfect. I'll just straight dive into it. We just heard, the evolution of markets. A lot has been talked about, notwithstanding what's happened in the last 15, 18 months. The journey India has seen, it's been quite a phenomenal journey. But I think a lot has been talked about in the financial press in terms of the numbers stacking up, right? Especially from the perspective from October 24, the exodus that we have seen from a foreign perspective, FPIs, the numbers are quite staggering actually. 33 billion has left the shores. And I would like to start with you, Swaroop sir. I think 21 to 24, India had great markets. China was uninvestable. And then we have seen this consolidation. Is it the fact that 21 to 23, we had a party which was supposed to end at 12, kind of the hangover lasted more than that? And when now seeing the consolidation of that, how do you see the interlay between domestic flow from your vantage point? And what is the importance of foreign flow? We keep talking about the fact that there's an anchor inflection point in India, but it clearly means what market is pricing in is that foreigners need to come back for the next bull run to start. So would love to hear your insights.
Yeah, thank you so much for having me on this incredible panel. Yeah, it does look like the foreigners have put an 80 to 90,000 crore SWP on India over the last 2-3 years. But it's more about what is available there than India, is my personal opinion. When you look at the government sovereign yield at 4.5% and put a rupee depreciation at 3% and our valuations where they are, it's a good thing to buy them rather than buy us. So we're seeing that consistent outflow. You ask any fund manager, how do they invest? They'll say buy a good asset at a good price. India is a great asset. Make no mistake, it is the structural growth story of the world. Maybe the price was not good. Luckily for us, the domestic flows are there, and I personally believe this is a structural now change. This domestic flow will not change. When I first predicted 25,000 crore SIP, nobody gave me a hoot on that one, but this is headed north only from here, and that will stay. But at the end of the day, both the monies are very important. While if you look at the recent intervention of having a structural risk addressed through of derivatives being owned by retail, there is also the risk of retail owning the market. That is growing. So both the sides are equally important, and both will play. I think we're just seeing the bottom of the market beginning to unfold, and I dare say we will see some money report. There's no problem with our market, is where I say. But I am of that camp that both the monies are very important, and make no mistake, I'm not in that camp that India's 30,000 crore will carry the market. It will take us nowhere, is my point.
Anand sir, I'll come to you. You've got the very vantage point of, experience in the private space, regulation and academia. There's a very interesting point you made on, concentration of the domestic risk part of it, especially if the foreign bid is not there. The question to you is, we have seen, in analysis, from a research point of view, we say, paralysis by over-analysis. From a regulation point of view, given your experience and what's been happening in India over the last 2 years, there is a very fine line as a regulator, the eye of the regulator as to what's happening in the intersection of market participants, whether to intervene and regulate or let market forces play out from a natural perspective. What has been your experience in that, and how do you see it? And also on the current environment, we are in a very, very precarious environment globally, geopolitically. India has been, we talked about the last 15, 18 months. Just your thoughts on the overall picture would be great.
Thanks a lot for having me. I think it's my hand that's the problem. So I'll just add to the
to what Swaroop explained so nicely, if you see FY25 as a example, in the entire fiscal year, the total demand that came for Indian equities, primary plus secondary put together, from domestic participants, which includes mutual funds, insurance companies, pension funds, and individuals coming directly, was $100 billion. It was 8.8 lakh crores, and that was equal to $100 billion in that year, right? There was about $15 billion of FPI outflow. So the net demand across domestic and foreigners was about $85 billion. Against that, if you be very liberal and count what is the fresh supply coming in form of IPOs, FPOs, rights issues, QIPs, all of that put together was about $50 billion. So the net demand in primary and secondary was 85. The net fresh supply of paper was $50 billion. Now, where is this balance 35 coming? Because for every demand, there has to be a supply. It was essentially promoters and strategic, holders selling in the secondary market to meet this demand. So this mismatch, by the way, both this $100 billion demand, $85 billion net demand, and the supply of $50 billion were all record highs. We've never seen numbers like this. So for capital formation, it's fantastic. High demand and high supply, fantastic. But this gap that we were seeing was also record high. And it was growing. It was zero 3 years ago. And today it was like, $35 billion. So just to emphasize the point, it's a very complicated multivariate analysis. You can't be very simplistic about it. But by the looks of it, Indians were putting too much of money into equity, not enough into fixed income, maybe because of tax, maybe because of other reasons, not enough into commodities, not enough into other global assets. There was too much of concentration happening here. As a result, not just in FPI, even in FDI, net FDI was zero in FY25. And the reason for that is, if you're a fresh person coming in, it's very difficult to find value when the valuations are so, at least pockets of valuations are so high. So there's no surprise that foreign investments actually have been drawing out given where the valuations, and as Swaroop mentioned, the relative valuations in China, September 24, the peak of our markets, our price earnings ratio was twice that of China, right? And imagine the kind of entity that China is with its story on AI, etc. So the good thing is time correction has happened. Markets have a way of self-correcting without regulators coming in the way. Today, if you look at the price earnings ratio of India vis-a-vis emerging markets, so if you see MSCI India versus MSCI EM, the difference in the price earnings ratio, it's back to the historical normals of about 30-40% higher than India's always higher. It's about 30-40% higher, which is back to normals. So that time correction is happening given the period of time. To your specific question on regulations, I'll give you my two-bit take. So earlier I was a trader in the currency and interest rate derivative markets. At that time, I had an extremely low opinion of regulators. They didn't understand. They came with completely silly regulations. There was complete, adherence to tick the boxes and, follow this rule. And you're missing the entire risk. You're crying about somebody jaywalking and you're sleeping when somebody is committing murder. So all these feelings we had about the regulator. Then I joined SEBI and I got to see the other side. And I'll tell you the SEBI side of the story. The SEBI side of the story is as follows. And I'll give you I don't want to give you specific examples, but I'll give you the broad gist. SEBI has about 1,000 people, 1,060 people when I left. Okay? We look after more than 20 different types of regulated entities. From mutual funds to, you saw Ashish here, exchanges, clearing corporations, investment advisors, brokers, you name it, right? PMSs, AIFs, FPIs. So the number of people in SEBI looking at any one department is about 20 or 30 if you're lucky. Surveillance is about 30, 40 people, right? And each of these, take merchant banking for instance, or take IPOs. Look at the changes which are happening in the market in such a rapid fashion. What do you expect regulators to be? Are we supermen who are supposed to understand and be ahead of what's happening in the market? The incentive structure is the opposite. Markets will always be ahead of the regulator, right? The market is better paid, better incentivized. Regulator is not. So here is what we see happening. Smart people take advantage of the ignorance of the regulator and ensure that they circumvent regulations or the intent of regulations and do egregiously wrong things. A biggest fear for a regulator is when something dramatically, visibly wrong happens. When Harshad Mehta happens, when Ketan Parekh happens, when a Karvi broking scandal happens. That is the thing that gives us nightmares. Imagine if tomorrow there is a cyber attack, a day zero attack, and all the data in the depositories becomes available in the public domain. Can you imagine what SEBI will be facing? तुम लोग गधे हो, ये तो सबको पता है कि day zero हो सकता है, क्या कर रहे थे तुम लोग? Right? So our biggest fear is this kind of an error happening. Now, if we don't know enough, and the reality is, guys, regulators don't know enough. If we don't know enough and we have a lot of fear, what will we do? We'll come with as many regulations as possible. Now, that creates a second type of error where the regulations come in the way of doing business. So my first request to market participants, there are plenty here, please educate the regulator. Do not assume that regulators have 10 hands and are gods. They're not. They are as naive as you can get. You have to educate them by talking about what is going wrong in the market. Every time I was there in SEBI for 3 years, I would hear people coming to me and crying about, "Tumhara ye regulation galat hai." Arey, why is that regulation there? What wrongdoing are we trying to prevent? What is your alternative to addressing that wrongdoing? I can tell you of 10 wrongdoings that I found out, that once I found out, I told the market participants, ye ho raha hai, haan ye to ho raha hai, sabko pata hai ho raha hai. Arey to bataye kyun nahi? Why am I finding out the hard way without you telling me? So what we need is market participants coming and talking to the regulator, saying, explaining ki boss ye galat ho raha hai. That will give the regulator confidence ki boss, now we have people who are trusted advisors whom we can trust. Now let's listen to them. What are our regulations wrong and how do we remove them? We have to talk to each other, not talk past each other. So having been both a regulated and a regulator, this is my prognosis. We need that dialogue to happen on an ongoing basis.
Thank you, sir. Hopefully the dialogue will continue with a lot of market participants here. Lakshmi and Andrew, you both sit at the crossroads or the intersection of both traditional and alternative assets. Lakshmi, I've heard you a few times. You have this, after such an animated response, I want to hear your Bollywood response. I think there has been a phenomenal growth in alternative assets in India. AIS PMS is 147 billion. Where I sit as a prime broker asset services provider, we are seeing the kind of profit growth in the country and Nuvama as well. The question here is the domestic equity investor getting mature and savvy enough, fast enough, and are there enough products and innovation happening, provided that you can still generate alpha? It's been a tough environment. Maybe people have come or are actually, given the fact that vanilla equity is not working, does that mean that you're seeing more and more conversations around high yield credit, alternate assets, and just your take on the current environment? Would love to hear that.
Sure. Thanks, Shiv, and hi, good evening to all of you. It's good to see the ex-regulator, the regulated, and all of them sitting together. I think that is a happy ecosystem, as I say. And then, yes, I do agree that we shouldn't talk past each other. We should talk with each other. The buzzword is collaborate and not compete. With respect to your question, Shiv, I'll say that investors want variety. There is no two ways about it. I think whether it is the investor in India or the investor globally, every day you give him or her dal chawal, they keep saying, yeah, you know what, just spike up this dal chawal a little bit, make it a little bit spicy, provided you don't get an ulcer. I love food apart from film. So, if you like pani puri, which is, the plain Jane one, why don't you give me a vodka infused pani puri, provided you're okay to get the kick, the after kick that is associated with the investment. So I think the investor journey is getting a little bit more mature. They are mindful of the risks that are associated with the investments. I would say by and large, okay, there are some small moles here and there, but that can't really make the entire ocean bad. So I would say that they want, and they are, very, very conscious of the fact that the risk is significantly stacked in their favor because they want to earn that commensurate return. So I think that's very, very clear. And that is why you are seeing the proliferation of investors move in from plain Jane equities, which is, say even available to my staff, for example, at a low amount of 500 rupees, to the entire ecosystem, which is, allowing you to take concentrated bets say through LVF, just having 2 stocks or 2 ideas in the portfolio. So I think that maturity, maybe 10 years back, if we would have had a conversation like this, I think we would still be talking about SIPs. While SIP is good, it's great, but now it's becoming like, oh, can you give me Bisleri? Somebody wants mineral water and they're asking for Bisleri. So I think it's become, so I think that evolution is happening. And to the point of where we are seeing the markets today, I think there is clearly a breakaway from Begani Shadi Mein Abdullah Diwana, which means that Shadi kahin pe jang kahin aur chhid rahi hai. So I think the second order effects for India, obviously we are clearly mindful of. But I think the fact that today also the markets were up, and I'm not talking about day-to-day markets, but clearly if you look at, and since we spoke about numbers, if you look at weekly outflows or weekly flows that we track. After March 2020, this was the worst ever weekly outflow that we saw last week, $18 odd billion. But hey, we're not the number one. We don't get the student of the outflow year title. That title actually goes to Taiwan, followed by Korea, and then, India is a close third. And the reason for that is very clear because, we are at what, 15, 17-year low as far as FPI ownership is concerned. They're just about 16% of India's total equity available. So it is a retail tsunami which is, kind of pushing in money as far as the markets are concerned. And that is allowing us, to kind of stay afloat. And we believe that, that status that, we can't completely be oblivious to what is happening across the world is definitely not something that we have arrived at, because obviously rupee is clearly playing a spoil sport. But I think in terms of holding its horns, I think like you have, you've seen the movie 3 Idiots?
Everyone has.
Okay, superb. So India is behaving like the rancho, which is, kind of striving for that excellence. Of course, you will have the viruses of the world, in this case, Viru Sahasrabuddhe, which will keep trying to haunt and taunt at every point in time. But clearly, we are not the silencers, which is more superficial. We have, like the 3 Idiots, we have 3 Ds, which is our demographic dividend, we have our digital infrastructure, and most importantly, our Brahmastra is our domestic consumption. So I think that would clearly summarize the mood. So we are not, this is the 3 Idiots analogy to take care of your Bollywood ticklers.
There you go. Thank you so much. Andrew sir, with you, since the panel is called Market Mavericks, we just talked about valuations. We are back at historical levels. I'm just going to go deep dive into you. Where do you see alpha right now? Where are you deploying money? What makes you excited? Small and mid caps have definitely corrected a lot more. While the Nifty has held up, the breadth in India has taken the brunt of the pain. Just your take, where do investors put money?
So, just before I answer that, let's go back a few years when we were coming off, we were one of the best performing markets in the world. China was, no one wanted to even talk about China. Everyone in India was saying, forget China +1, it's just India. So that's where we came from, right? The peak of kind of optimism, we were the best, we're going to continue to see returns very, very high, 20% plus. And earnings were never really catching up. And so therefore we started to see that drift. And then of course AI came along, and India's missed the bus on that one. All our IT companies, despite having knowledge of all of this, have done nothing apart from paying cash back to shareholders. It would have been much better used to look at AI or invest in AI where they were at the forefront. So when we say that China was cheap, it was cheap because people didn't like it. But when the AI came along, then that's where your money went, and that's where it's going to continue to go. So now we're in this kind of dilemma of, even if, let's just say, the Iranian kind of dispute kind of comes to an end, everyone's going to go back to the AI trade. So India doesn't really get any money. And our valuations are still, even though they're where they are, let me put it slightly differently. With all that's going on, our earnings now going to be downgraded again. So therefore, the PE is not the right PE. If I take IT, again, a month or so ago when everyone talked about AI, the narrative both from the companies and the research analyst community was it's all okay. Now since then, most broking houses have reduced their target prices for IT across the board anywhere from 30 to 50%. Now, if you reduce your share price targets by 30 to 50%, it must mean you're going to bring your earnings down at some point, right? Unless they're saying they're going to value IT companies as utilities. Maybe that's what they're going to do. So there's a big earnings kind of downswift which could come led by IT. And if IT has any kind of problems, that will have an impact on real estate, in spending, so forth and so on. So that's where we are. We're kind of stuck in the middle of, even if the war continues, it's going to really impact us. And I don't think the market's really looking at that. We're listening to what Trump says and it's going to be okay. Maybe it will be. But I think we're just stuck at the moment where we don't have the earnings momentum just to push us. And of course, all the flows that are coming domestically are being eaten away by all the domestic issuance that we're seeing. So
Fair
it's
enough.
Tough market.
Yep. So, Rup sir, I'm going to come back to you. Given what happened over the weekend, I don't think many people were factoring in. The war happened, everyone was kind of complacent on oil until the spike happened. Given the spike, a lot of anecdotes have come out on India, especially 90% imported. The INR is going to depreciate. Are you already in your portfolios at the team going back and kind of reworking the models, putting that in perspective that this could be much more prolonged? Most of the panels that I heard since morning, I think that especially on the private equity side that was discussed, I think people are not factoring in more than a 4.5% depreciation on the INR. My view is slightly different. I think, if oil does sustain above 80 or 100, I think the INR would be under a lot more pressure. And that would have a lot more pressure on the domestic consumption basket that, we just discussed. What's your take on it? How are you looking at it?
I think the last time I gave my views on the INR, the crowd said, "Deske hit mein baat kijiye." So I'll reserve my views on the INR and leave it at that. But there are two types of wars. There is a war, and when US or China gets involved in the war, it's a different ball game. And we are seeing that unfolding. I don't think we've seen the end of this yet. It's a story which will happen. The world has changed, and make no mistake, we are in the midst of history, and we are seeing an era change happening. And of course, this is probably the time when China will make its move, and it is making its move. My 30 years of tracking this market was summarized in 2008 when the great Warren Buffett said that the world will trade in dollars. So I left it at that. But at a time when sovereign gold reserves are ahead of the dollar is not the dollar anymore. And the last 2 days signaled the other change in the other currency called oil. There is a risk to that which we have to address. The other risk which you have to address is what Andrew kind of yielded to, the impact or the serious impact of IT and the lack of AI on India in the next 2-3 years, which the team is more deep diving into than the oil, let's be, from our point of view. But from our fund management perspective, we are absolutely invested in the market. We don't take cash calls as a rule. As the markets change, the stocks can change, but we will not play the cash rule ever. If people give us money to buy an asset class, as a fund management team, we back ourselves to getting 70 to 80 good stories at any point of time. If you ask Lakshmi or you ask Andrew, they will tell you what I said. You buy a good asset at a good price. There are some great assets available at good prices. If you dig in now and have a little bit of patience to wait this one over, there's a lot of wealth to be made. In this room, there'll be two types of people. One who looks at BSC at 80,000, one who looks at India at 8 trillion. Right? It depends. It's your money. It depends how you look at it. Both of you can be right. But the one who looks at India at 8 trillion will behave dramatically different to the one who looks at 80,000, is the point I'm making. We look at India at 8 trillion. We might have investors losing patience with us in the near term, but the only two people who make money in mutual funds are, the first one is the person who's lost his or her account statement, and the second one is the person who's dead. Right? So the person who digs deep, stay invested this on a decadal run, probably will be the only country which will grow at 6 to 7%. There's no country like that. You have to stay invested to remain and enjoy that wealth. And one of the best way of getting that 8 trillion to your economy, to your portfolio, is through the capital markets. We believe in that, and we back our team in getting 80, 90 good stories at any point of time into our portfolios.
No, well said, sir. I think India is a classic example, or it's not timing the market, but time in the market. I was a macro trader in my previous avatar, and I'm going to go to another macro trader in his previous avatar. Just your take on the macro situation, sir, would be lovely.
So this is a former SEBI person speaking, so it's not the official view of SEBI. SEBI has no view on valuations, etc. And by the way, to Swaroop's point about what the audience tells him, if you make money on my view, then please remember me. If you lose money, then you're working on your own. So look, even before what happened over since 28th of February, frankly, on the balance of payments, there was always a question mark because we were not getting enough capital flows. Our current account deficit was fine, but we were simply not getting enough net capital flows, which is why rupee was on a depreciating path even before 28th of February. That's something to be remembered. I'll put it this way. I'll just take up from what Andrew, and I think Andrew put it very realistically, to combine what Swaroop also said. The long-term story of India, I think we're all convinced about. I don't think there's anybody in this room who doesn't agree with that. But given the uncertainties that we have currently, our dependence, 90% of our oil is imported, as you said, the fact that our capital flows have not been great, and the fact that our interest rates are relatively low compared to historical levels. You know, there is this lovely point in economics, which is called the impossible trinity. You can't have an independent monetary policy, free capital flows, and a stable currency all at the same time. Now, we've got to make a choice. Do we want interest rates to remain very, very low by us doing OMOs and, you know, flushing in liquidity? Or do you want rupee to be stable? Or do you end up with neither, right? So I think that choice has to be made. The risk premium on India probably needs to go up. Because let's face it, there are risks. If oil prices stay at 100, there is a problem. If you know, we don't develop an AI story, if the services sector suffers, that's a problem. We don't dispute what's going to happen eventually, but the risk premium probably needs to go up. So you will see volatility, but once that risk premium is built in, I think then we'll have a smooth sailing going after. So maybe 3 months of correction, 6 months of correction, and thereafter I think it should be fine.
Perfect. I have a rapid fire question. You get 3 choices. You have to choose one. And I'm going to ask, the question is, if you had to pick one defining shift for the next few years in India perspective, which one of the 3 would it be? The total disappearance of FII influence given the domestic wave, the rise of the digital retail wave that we're continuing to see continues, and the last is the emergence of India as a global hub for private credit, given the fact that, you know, I've been reading a lot about private credit in the US and it's kind of faltering. There are a lot of fault lines developing there. Does that hot money come to India? Why don't we start in order of preference?
I'll just change one of your sentences to say I'm banking on the young investing in India. Because if you look at the data ending 2026, 60% of our investors will become less than 30 years. And their investing will be, we may not have any correlation to our investing, and that's what will spur the market. It's for us to also respect their risk-taking capability. If we respect their risk-taking capability and their ability to own the risk, a lot of products from our side will change. Otherwise, we will become the largest Bitcoin trading country in the world.
Well said. Lakshmi, over to you. 3 choices.
I forgot your 3 choices. I think the rise of the retail digital investor, is that what you said?
Yeah,
I
or
think,
the disappearance of the FII influence.
No, I think FPIs will not go completely kaput. I think they will. Do you watch Telugu movies? No.
No.
But with Hindi
Unfortunately.
subtitle. Have you seen a movie called Pushpa?
Yeah, of course.
Allu Arjun? Yeah.
Yeah.
So there was a very interesting dialogue in that. For those who've not seen, it's available on Netflix. It said that Pushpa, naam sunke flower samjhi kya, fire hai main. So I think India is actually like that fire. You know, it is an emerging economy. So India is saying that India naam sunke emerging market samjhe kya, fire hai main. So I think FPIs will not disappear. That's point number 1. But I think India will morph itself substantially from phygital to digital. I think that is the trend that I'm clearly seeing.
I have a request. You should do a LinkedIn post on all these anecdotes that you have. I think you'll get more followers. Andrew, sir.
Sorry, I'm not going to follow your... so I think what I would want to see is more education about asset allocation. Because you said one of the things you said is time in the market. I'm not a great believer of time in the market. Because it's not about the timing. It's if you've been in the market for the last 2 years, you haven't made any money. you would have made lots of money in gold and silver. So asset allocation, education of asset allocation, and Anand said, in terms of no one's buying bonds, why not? So I think asset allocation would be something I would want to see.
Thank you, sir.
So I'm going to, because I'm an ex-regulator, I'm going to change the syllabus. I'm going to go for a fourth answer.
As you should.
All the things that you mentioned are related in relation to the capital markets. Now, frankly, capital markets should rest on the real economy. And to me, if you have a strong real economy, the rest will fall in shape. Asset allocation, all the assets will fall in shape. If there is one defining change, I think for all of us, and I'm an old fogey, many young people out here, it is artificial intelligence, right? It is going to redefine every single line of our businesses. It is going to redefine our capital markets. It's going to redefine. I'm an old fogey. I'm now looking up Claude Cowork. I'm doing a lot of the macro, analysis in my own little way, in ways I couldn't imagine before. I shudder to think what the market is going to look like in 10 years from now. I don't think we can predict it. Now, if you want India to do well, we should be defining the future and our place in AI rather than reacting to what's happening globally. Unless that happens, I think that shift happens, we'll be in trouble. So if anything, one thing for me is, all you young people out here, stop listening to old foggies like me. We don't know what the hell is the future is going to look like. Redefine the future. You define the future. As long as you do that, we'll be okay.
Ladies and gentlemen, it's been an absolute pleasure. I hope you guys enjoyed it. Thank you so much. I think we have an official picture, but thank you. Sir.
Right. We now have our penultimate chat. By the way, there is a drinks and networking reception at the end of this in about 20 or so minutes. So please stick around for our drinks and networking reception. But first, we've got two discussions, so don't go anywhere or you'll be in trouble. Bharat, where are you? Bharat Shivappa, President Markets at GIFT City. This is our chat all about GIFT City, the gateway to global capital. Excuse the noise. Right, you came from Abu Dhabi, didn't you? Before GIFT, you were at Abu Dhabi Global Markets, which is Abu Dhabi's version. It came before GIFT City. It was established in 2013. So what did you learn from DGM, is that mic on? Hello, 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 yeah. What can we borrow, steal, learn, Bharat, from Abu Dhabi Global Markets? What can GIFT City borrow, beg and steal? What are the lessons?
Yeah, my current status, Mike, is Bharat from GIFT City.
Yes, of course.
Month old now.
Yeah.
But good question. I joined not back in 2013 or 15 when they started, but just after COVID, 2022. Yeah. I think what GIFT City delivered was a very different product, like for them, if you look at the onshore was Sharia, so they have no option but to adopt something completely different, right? So they adopted English common law directly.
Yeah.
And they were ability to kind of build that in a very short notice, right? So, and then they capitalize on their strength, which is access to capital, right? Common law, access to capital, I think delivered them. Dubai pivoted a little bit and leveraged on the family offices and delivered a similar product, right? For GIFT, the scenario changes.
Yeah.
This umbrella is larger, right? So for us, yeah, some of those, I would take from them was that razor sharpness that they built, right? The focus that they, like matured into in a very short span, and identify those strengths that they can accelerate. I would take those as a lessons for GIFT. While we have kind of built a phenomenal regulatory products, if I may use for lack of words, and building a larger ecosystem for attracting global capital. But I think, further accelerating on those supercharged areas is what I would focus and I would take as a learning.
Yeah, yeah. What role can GIFT be? Because there's many of these financial centers, Abu Dhabi, Dubai, Singapore's been around forever, Hong Kong. What role can GIFT City play in this world where there are lots of economic zones and financial centers?
Like every IFC is built for different solving a purpose, but there are a lot of commonalities. We want to create a home outside a home for different countries. For example, somebody is coming from, let's say, East Europe or Central Europe to come and have a structure which is like his home structure in a foreign country is what IFC solve by default. Now, how how different GIFT could be is GIFT compared to rest of the IFCs unlocks a tremendous access to market. Now, world is talking about global south. They realize the power of global south. And India has a big chunk of the global south. You can, I want you to kind of imagine the, like story from closer to 5 trillion to a 30 trillion, what we are talking about, 2047. And GIFT today can be one of those critical nerve centers that unlocks this opportunity. Immediate domestic Indian opportunity, plus, the Indian large partnerships today, whether it is DTTs, whether it is trade or SEPA, a combination of that opportunity that India unlocks is what makes India and therefore GIFT different and stand out.
It's not just about businesses, it's about people as well, the city itself. What about that side of things?
Yeah, I think that's a very great point. Reason why, because when you're building an IFC, you're not just solving for businesses and structures and taxes. You're actually solving for building a world-class infrastructure, city itself. That's why we call it city, where we also address the people quotient, business and people. So building great infrastructure is a critical, I would say, like a critical requirement for building a comprehensive, a world-class city. And today, as GIFT, we are, we are not just in the planning, but we are already in work in progress in a very advanced stage. We have built today a complete underground tunnel to manage your all water, sewage. It's almost 6 kilometers today, and by end of the next year, it should be almost 16 kilometers. We have built a district cooling system. We have built, like a world-class waste management system. Transportation, we are almost like solving for a 20-minute city between twin cities. I have metro running through. We have like airport to GIFT City is 20 minutes. And also, I would say very enviable direct connects, mobility in terms of direct air routes and access to, again, both sea and water and roadways. So if you look at, we are solving there for both businesses and people to come and live in.
Important businesses and people. You've just released this consultation paper on tokenization. Why should our lovely audience care about tokenization?
Yeah, I think, look, nuanced finance is something that we can't ignore today, right? Around us, all the names that you mentioned are in different stages of delivering a nuanced, financial structures, whether some people have taken on tokenization, some people are even exploring non-fungible tokens to kind of trade, and so on and so forth. But for us to kind of at least explore some of those possibilities on tokenization is a good thing to do. I'm not kind of commenting as to we are there, substantially in kind of bringing those regulatory products. But a lot of those are something that we can't ignore, and we need to constantly innovate, right? We have to be constantly, I would say, progressive as a regulator. Because this is what market wants, right? When market wants, we need to take consultation from the public, understand what they need, and then figure out what is feasible. That's how it works, right? Then you kind of, look at your risk levels, how can I, the possibilities and impossibilities of delivering a regulatory product. Those are the things that comes next. But today, the fact that our regulators are evaluating some of these products is a great thing. It's a good sign of a progressive regulator.
Final question, Bharath. 2030 is a big theme of today. Put your 2030 hat on. What does GIFT City look like in 2030 when it comes to capital, catalyzing capital, which is the buzz phrase of IGF Mumbai 2026?
Yeah, I would really think of giving at least a good sweat for my peers by 2030. The reason why I'm saying is, look at this, it comes from is a country level progressiveness, right? If you look at 2024 budget, there was a mention of VCCs by our finance minister, which is a great product to kind of give access to some of the UHNIs, some of the family offices who are currently housing in Singapore and Dubais of the rest of the world to come and explore those products, right? Once we have those in place. So that's on regulatory and also on family fund structures and various structures. I'm sure we are progressing in the right direction today. So I will solve for progressive regulations. I'm solving for a tremendous infrastructure for people to come, live, and thrive from GIFT City. And then I'm solving for a great connectivity and leadership involvement. Today, this is led from the very top, right? We have today attracting global talents, like I came here. I have a lot of colleagues who moved from Singapore and other locations and joining GIFT and trying to bring that global experience. So we are accelerating. We have identified some of our priority areas and we are supercharging at it, right? From the very top. I think this is the moment where we kind of take that hockey stick and accelerate.
Yeah.
Right? So I would look for a very, very, one of my colleagues very, very passionately said that I'm ready to sign off a stamp paper and put your name that 2030 you'll be there. And he was talking to one of the top-notch finance leader.
Nice. Take the whole hockey stick and accelerate it. I like that. Great way to end. Well done. Congratulations. Good luck to GIFT City. Big, big round of applause for Bharath. There's one more discussion. Don't you dare leave. Don't you dare leave. Thank you so much. Networking and drinks in just a second. Quick photo, Bharath. And then we'll have our final chat of the day. Good to see you. Our geopolitical chat. Great. Thank you very much. Right. Thank you. Yep, you could leave that there. Yep. Brilliant. Okay. So as I said, it's our final discussion of the day. And after this, we have our wonderful networking drinks. So please do stick around. We're saving a very important chat. Geopolitical capital. Very important theme. I want to invite Sanjay Sudhir, former Indian ambassador to the UAE. Big round of applause. And Dr. Vijay Chautawali, in charge, Department of Foreign Affairs at BJP. Gentlemen, we've got 10 minutes to try and put the world to rights. I don't know how we're going to do that, but we'll certainly do our best. And like I said, there'll be a networking session afterwards. Ambassador, thank you so much for joining us. You join us at a difficult time, very, very difficult time, specifically in the region where you did so much good, particularly for the India-UAE relationship. Some thoughts, just let it all out. The last 10 days, what's been going through your mind?
I think there is a serious reordering of geopolitics in the Middle East. And I think history is in the process of being written because this kind of whatever is happening now has never been witnessed in this part of the world because everybody did feel that it's always very explosive, but it could really explode like this, something nobody would have ever imagined. But I think what comes out of it will have a very long-lasting impact on how countries of the Middle East relate to each other and how they relate to countries like the US and countries in Europe and so many other countries.
Yeah. Vijay, you, I know, will have a view on this. Prime Minister Modi was in Israel just a few days before this started, and he's been under a fair amount of criticism. What does that visit tell us when it comes to India's neutrality, non-alignment, because many have pounced on it saying, oh, it sent the wrong signals. What signal does it send to the rest of the world?
So first of all, non-alignment is a past. Multilateralism is the present. And in that context, one must understand that Prime Minister Modi was the first Indian Prime Minister ever to visit Israel in 2017. And since then, both the leaders of India and Israel, they have developed a very strong personal friendship, as well as the India-Israel relations have gone to the next level. So this was a natural consequence that Prime Minister Modi visits that country second time. But it was never at the cost of our friends in the Gulf. And therefore, as my Ambassador Sudhir will confirm, that our relations with the Gulf countries in GCC were also made equally strong. Prime Minister Modi has visited UAE for 7 times in last...
Yes, 7 times in all, 4 times in the last 4 years.
4 times. And then the President of UAE has visited India 3 times or 4 times.
4 times.
4 times. So this is not a zero-sum game that if we do this, we cannot do this. So Prime Minister Modi has done an enormous job of balancing it. And therefore, I fully support, and it was the right time. And in global circumstances, there is never a perfect right time to visit any country. So you have to find the best opportunity to build the bridges.
Is it possible to balance, though? I mean, looking at I2, U2, which of course you've got Israel, the UAE, the UAS. Israel and the US have gone into Iran as a result. We're seeing missiles and drones over the UAE, Bahrain, Saudi Arabia, Qatar, just to name a few of those nations. Does that show you the flaws in this multi-alignment world? How do we find that balance if we're the Indian government today?
Actually, Indian government has been able to find that balance. And as Vijayji just mentioned, we are no longer in the non-aligned era, but in an era of multi-alignment. And in the last 10 years, you would have seen that how much work we have done with all of them separately. In fact, last 10 years, we have had strategic partnership agreements with 5 out of the 6 GCC countries, and deepening of relationship with Israel at the same time. We have about 10 million Indian diaspora in that part of the world, defense engagement, all kinds of engagement. So, but then nothing has been at the cost of the other. As Vijay just mentioned, it's not a zero-sum game, it's a win-win proposition. So it's not just about our bilateral win-win, but also about a regional win-win. For instance, some countries of the Middle East were trying to normalize relations with Israel under, say, the Abraham Accord. A very logical extension of that was the I2U2, which carried that whole process forward. And a further extension of this was the visionary IMEC project, which is all about India, Middle East, and Europe Economic Corridor. So India's effort always has been to bring everybody together for development and for prosperity.
Is that connectivity, this desire to bring everyone together, Vijay, is it still on? And we've got the, as you say, Ambassador, the India, Middle East, Europe corridor. We've got the SEPA, which you were a massive part of. We've got Chabahar. The government is betting heavily on this connectivity through a region that now is at war. So is that strategy broken, or does this prove actually that this strategy does have value?
I think each of these programs or alignment which you have mentioned has a specific purpose. Some part is for connectivity. Chabahar was mainly to avoid Pakistan and go to the Central Asia. So I don't think these are dead projects. They are still very much alive. There are definitely some hurdles now with the developing situation in Gaza and now in the Iran versus the Israel. But I am sure in the long run, these projects are going to be beneficial not only to India but also in all the partnering countries, and they will progress at some time. And as we have heard yesterday with Maharashtra's Chief Minister, that he is already preparing a new port, that we are already preparing ourselves, that if this project, the day it is launched, we will have a first mover advantage.
I was going to start this discussion before the Iran war. about your achievements. The CEPA, which was negotiated in just 88 days. I mean, absolutely incredible. So we're not gonna miss an opportunity to talk about it because it's still so important. It's been disrupted, the trade corridor, but still that fantastic achievement sits with us. How resilient is that trade corridor? And 88 days to forge a trade agreement. Is that the future? Do we still have a goal? Not just India, but other nations, to forge trade ties in such a short amount of time? Because some last years and years and years.
I think CEPA was not a destination, it was just a milestone along the way. Because after we signed our CEPA in 2022, our bilateral trade has crossed $100 billion, which is quite substantial. And after that, UAE has signed about 25 more CEPAs. We have signed several CEPAs with major economic powers like Australia, EU, EFTA, Oman, UK. So I think we have all gained by that experience, and eventually our leaders' philosophy and the country's philosophy is to increase trade and prosperity, to increase connectivity. And you mentioned Chabahar, IMEC. They're all about connecting people, connecting businesses, so that we all come together on a common platform for enhancing prosperity and development.
Yeah. Vijay, what's the relationship now between India and the US? The US, it seems, has just given permission for India to buy Russian oil. It's got a 1-month window. Obviously, oil has been up and down the last couple of days, 90 to 120 to 90. I mean, we live in a very, very volatile environment. How would you term India's relationship with the US? Because you struck this interim trade deal, then the Supreme Court struck down the tariffs, which makes it unclear what's happened to trade deals, not just between India and the US, but the US and other countries. How's the current relationship?
See, permission is given when someone seeks the permission. And I don't see any report where India has sought a permission from US to buy Russian oil.
Yeah.
India has always said that we will do whatever is best in our interest. So it says everything. This is as far as this specific issue is concerned.
Yeah.
We were talking the deal with US for many years, including Mr. Trump's first term. So it is a natural development that we are talking about it and we are trying to conclude about it. But even if we keep this trade issue and tariff issue separate, which is of course a kind of a bitterness has developed, overall India-US cooperation is still very strong on multiple fronts, including the defense front. And there are several high-level exchange visits, even on the defense side, with the senior officers of defense from either side. And on our cultural side, diaspora, many engagements are taking place. So I would say that, of course, tariff is one irritant, but we should not evaluate India-US relationship with only one yardstick of tariffs.
Yeah. Final word to you both. 2030 is a big theme. Put your 2030 hat on, Ambassador. Is everything calm in 2030? The India-UAE corridor, are we back to what it was? What does the world look like in 4 years' time? I know we can't even predict what it's going to look like in a week, but let's look ahead to 2030. What's your wish?
I think it's more difficult to predict about 1 week ahead.
Yeah.
But 2030, I'm sure, seeing the resilience of the UAE and the Gulf countries and India, our relationship will definitely go from strength to strength.
Yeah.
And we will be moving closer and closer towards the Prime Minister's dream of Viksit Bharat, a developed India, developed country by 2047.
Yeah. Vijay, 2030?
I think as far as India-UAE relations are concerned, what he has said, I fully endorse that they will go from stronger to strength. And as far as the world situation is concerned, we are not astrologers, we cannot predict it. What we can say that if whatever situation is there, under Prime Minister Modi's leadership, India is resilient enough, strong enough, not only to face it, but also excel India on the world stage. And that is for sure, I can predict.
Fantastic. By the way, there is a closed door session with Ambassador Sudhir for IGF members after this. So another reason why you should be interested in becoming a IGF member. If you are interested, please do go up to one of the members of the team, because this is just one of the many perks, these fantastic discussions that take place behind closed doors. Let's give a massive round of applause to our fantastic guests. Thank you. Thank you very much. Yeah. Thank you very much indeed. Thank you. I think we've got a video, and then I'm going to say goodbye to you. So just watch this video. It's a 1-minute video. It's on the IGF networks, and then I'll say goodbye.
What happens when two of the world's great democracies decide to move faster? From Mumbai's trading floors to London's corridors of influence, for 8 years, UK India Week has been the room where it happens. Capital, innovation, scale. West Midlands to the City of London, bringing together leaders in finance, AI, life sciences, and other frontier technologies. UK India Week is back. This year's theme, Capital Corridors, exploring the future of UK India innovation. 22nd to 26th June 2026. The room is already filling. Secure your place now.